Good evening, everybody. Can you hear me okay? Thumbs up. Hearing me, hearing me? How about now? Good? Okay. Got gremlins in the system today. Things changing unexplainedly. So hopefully we'll be in good shape. All right. Good to see you. Hope you had a good 24 hours. We are heading toward loan types from our current chapter on finance. That's chapters 14 and 15, which is syllabus section 11. We did a good bit of math last night. We talked about that foreclosure process. But just to recap a little bit. Tell me, thank you for the chat. Tell me in the chat, what are some of those clauses you might find in a promissory note? Promissory note. When you sign that promissory note, the lender may, but probably will, put some extra rules in there in the form of clauses. And tell me a couple of those clauses. There we go. Yeah. The acceleration clause, tell me what that one means. What do we mean by acceleration clause? They make you pay the whole amount in what situation? What has to happen for that acceleration clause to be triggered? Make you pay the whole amount in the event of, there we go. Yeah, if you let down your end of the bargain, if you miss payments, if you're late or miss payments. Depends on the lender and when they want to do that, but they reserve the right to accelerate the full amount due, way ahead of schedule. And very few people can handle that. What's another one? What's another clause that might be found in a promissory note? Oh, there's the other A word, alienation. What's another word for alienation clause? Beautiful. Look at you guys showing off. Alienation clause, also known as the due on sale clause. You got it. Because that's literally what happens. The lender's not going to let you just carry that loan balance if you decide to alienate yourself from this loan. They want their money. What sorts of events could trigger the alienation or due on sale clause? What sort of thing could make that lender demand their money because you are alienating yourself from the property? Well, there's one. Yeah, you bet. It's called the due on sale clause. So when you sell it, that's one. But remember, alienation means you are transferring it or distancing yourself from it. You're alienating yourself from it. It could also happen, there it is, when you refinance. Yeah. Because as far as that lender's concerned, you refinance with another lender. Lender number one is no longer in the picture. And you better believe they want their money. So refinance can trigger that alienation clause too. Let me share some stuff with you here. There we go. All right. Good. Okay. So we have the acceleration clause, we have the alienation or due on sale clause, and what's another one? One more that we talked about that could be, maybe, might be in that agreement. There you go. Thank you. Just lost the display. Hang on. Bear with me one moment. But yeah, that you got it. Prepayment penalty means that if you pay the loan off early, not that you can't, but if you do, you're going to pay a price for that. You're going to be paying a penalty for that. There we go. And that prepayment penalty is not in every loan. Tell me what types of loans might not include or cannot or not allowed to have a prepayment penalty in them. Yeah, government-related loans, yeah. FHA or VA loans, which we'll learn about tonight. You bet. And then also in North Carolina, a loan that is the principal, that is where the principal amount borrowed is $150,000 or less. $150,000 or less, the principal amount borrowed. So can't have a prepayment penalty there. But what could you, when could you see a prepayment penalty? What kind of loan might you see a prepayment penalty? Not FHA, not VA, not loans of 150 or less, but a refinance. Quite often, as a broker, do we have a responsibility to maybe warn our client that that could be a thing? Look out for that prepayment penalty. We have that fiduciary responsibility. Holly mentions a jumbo loan. What do we mean by a jumbo loan? We'll get a little more into that tonight. That means a loan that's past a certain point, past a certain loan amount for bigger houses, more expensive houses. And we'll dig into that some more tonight. What about the type of mortgages? South Carolina does it a little differently than North Carolina. What is it called in South Carolina? Tell me about mortgages in South Carolina. Yeah, it's a lien theory state, you bet. How many parties to that process? 2-party or 3-party? That's a 2-party system. It's called a mortgage. It's not called the other thing. In North Carolina, what is it called if it's not a mortgage? South Carolina is the mortgage state, 2-party state, lien theory state. North Carolina is a deed of trust system. And that's how many parties to a deed of trust system? That's 3. Who's that third party? Borrower, lender, and the trustee, probably an attorney, but you bet, trustee. And that is the one who's actually sending the letter, the bad news letter in the mail. Oh, we're going to foreclose. That lender has chosen to start the foreclosure process. It's going to come and arrive from that attorney trustee person. So here's our lien theory state. A couple of, there's another one. In North Carolina, they don't have to sue. The lender doesn't have to sue you, take you to court to sue you for foreclosure. You already gave them permission when you signed the due on sale clause. So it's quicker in North Carolina to foreclose than in South Carolina. Then the terms of the parties. In South Carolina, that lien theory, the borrower is known as the mortgagor because they're giving the mortgage. What is it about the mortgage? Is that the same thing as a promissory note? What are we using the mortgage for? Yeah, they're very different documents. The mortgage is the thing that ties the property into the mix. The mortgage pledges the property as collateral. Thank you, Catherine. The promissory note is the thing that outlines the loan terms, and the mortgage puts the property up as collateral. That's what makes it so that you could lose your property if you don't pay. So in that lien theory type of state like South Carolina, the borrower is called the mortgagor, the lender is called the mortgagee. In North Carolina, the borrower is the grantor, the lender is the beneficiary, and the trustee is the attorney who's going to carry out the foreclosure, the process of foreclosure. And then who retains the different kinds of title? In North Carolina, that trustee holds the legal title until you've paid the note in full. Once you've paid it off after 20, 30 years, however long your mortgage goes, then the legal title goes to the borrower. But along the way, that whole time, they held the equitable title. And then over in the South Carolina system, since it's only a two-party state, the borrower holds both the legal and equitable title. We talked about some ways to avoid foreclosure. Some of those ways include the right of the lender to put a deficiency judgment on that borrower. Basically a lien, like a general lien. Because remember, a general lien is that bucket of types of liens that can attach to the person. A specific lien is going to just attach to the property. So once that person walks away from the foreclosure, they could still owe money. Foreclosure might not have satisfied it. If they were lucky enough to avoid foreclosure by using something like this, the short sale, then the lender could also put a deficiency judgment against that borrower. They might not be finished when they sell the property in that short sale. They might still have to pay more money at some point later. The other part about the short sale is it is indeed a material fact. You've got to tell the world that you've listed that property, and your listing is your seller is trying to get a short sale approval, because it may or may not even happen, by the way, right? They're going to ask for the short sale. Hey, lender, would you please let me pay you less than I owe you? Don't break my thumbs. But they don't have to agree to that. They could say, nope, you can't sell it for enough. We're not happy with that much less than what you owe us. And what happens if they don't grant the short sale? That lender says, no, we're not going to do a short sale. It's been 9 months. It took us to figure this out, but we are saying no to you. I don't care that you have a buyer. The buyer's not willing to pay enough to get close enough to what you owe us for us to go along with that. What's that lender's other option if they don't grant the short sale? The big bad wolf, right? The worst possible thing. If they don't grant that short sale, they could just say, well, let's just let it go to foreclosure. Not pretty, right? So they don't have to. This short sale would be a privilege. This short sale would be a favor, and it would have to work for the lender's satisfaction, right? If the lender doesn't feel like it's beneficial to them too, and they can get close enough to be satisfied, they don't have to do it. Another way to avoid foreclosure is for that borrower or seller to just basically say, well, you know what, here's the keys. I'll just leave. Don't foreclose on me. Let's not go through that hassle. You can just have the house back. A deed in lieu of foreclosure. That avoids foreclosure if the lender will allow it. They may not. But if they do, the borrower still could end up with a deficiency judgment after the fact. Then we got into some math, and we had some terms, and we talked about the difference between interest and principal. And we got into that horrible type of problem. What is the loan amount or loan balance after the first month's payment? What a couple of calculations did we need to know how to do to determine the loan balance after the first month's payment? Do you remember? We'll walk through it, but tell me if you remember. What's one of the things we needed to calculate? Yeah, there we go. Annual interest, so that we can get what kind of interest? We start with annual because we're working our way down to monthly. Yeah, you bet. We need to know how much of the payment went toward interest. How much of that first month's payment went toward paying interest to the lender, so that we can subtract it from the total monthly payment, P&I. That's going to tell us how much we were able to buy our loan down or pay the principal loan amount down. Might mean more to see it rather than say it. So let's look at one. And so we have a situation like this. They might really be jerks to you and say the sale price is $375. The loan to value ratio is 95%. Let's pick a real live actual loan factor. Let's say 7 for 30 years. I believe it looks like 6.49. A 7% interest rate for 30 years is a 6.49 loan factor. I think that's all we need. So the question would be, what's the loan balance after the second monthly payment? And so here are the steps. Step 1. Let's figure out that monthly payment. Do we have what we need to do that? We probably need to use those first two pieces of information to get the loan amount, don't we? So we need to use these two things together to get the loan amount. And that loan amount is a weird one, $356,250. Let me just give you time to do a little bit of that, and we'll talk about it in just a second. You could put it in the chat when you're ready, then we'll walk through it. Whatever you want to do. I don't care. We're going to walk through the whole thing, but if you want to go through the whole thing yourself, go ahead and do that. That'd be good. That'd be good. So just work your way through the whole thing. Or let's just say after the first month. We'll do that far. Then we'll go after the second month. Looking for loan balance. We'll do after the first month first. Then we'll do the second month. So we've got our loan amount of the $356,250. Now, step 1. Let's determine the monthly principal and interest. What's that monthly house payment? Just the principal and interest portion. Then we're going to use the loan factor and the loan amount to get it. So we're going to use our loan amount multiplied by our loan factor. But what do I need to do to that loan amount first? I can go ahead and multiply it by the loan factor, but it's going to give me a ridiculously huge number. So if you actually forget that step and do it on the test and you end up with this 2,300,000, you can see there on my calculator, you're going to think, oh yeah, I forgot to divide by 1,000. So no big deal, not a bad problem. Just do it now. Just go ahead and throw it in there now and you're still okay. So 2312.06 is our monthly principal and interest payment. Yes, you do need to divide that loan balance by 1,000, but you could do the whole thing by 1,000 if you forgot to do it right away. Just catch it, right? Just don't forget. Now that we know our monthly P&I, step 2, let's figure out how much of I to subtract from it. We know the P&I. We know that of that payment of $23.12 and some change, a big majority of it is the I, and a little bit of it is the principal amount that's going down. So we need to figure out the I so that we can do subtraction and end up knowing what the P portion was of that payment. So now we're going to use the interest rate and the loan amount. When we do that, it's going to give us what Marcus says is the annual interest so that we can back into the monthly interest. There's our annual, $24,937.50. We're going to divide that by 12 to get our monthly interest. And that should be less than the monthly principal and interest. And it is. So we're going to subtract it from this 2312.06. And that shows us that we paid our principal loan balance down by almost $234. And then step 3, I don't know if I did the same steps as last time, but we're going to take that $356,250 and subtract that $233 to find out what we have as a loan balance at the end of month 1 after making that first payment. And it's come all the way down to $356,016 and 7 cents. Is that what you got? I'm seeing that in the chat. Good job. That's month 1. It asked for month 2. So now we have to do part of this over again with new numbers. We don't need to do step 1 because we can use the same monthly payment. That has not changed. Still the same payment. It's what portion of the payment is going toward interest. That's what changes. So we're going to pick it up with step 2. So this time with step 2, we're going to insert our newly acquired loan balance. Multiply that by the interest rate to get our annual interest based on the new loan balance. And we're going to divide that by 12 to get the monthly version. And that gives us a monthly amount of interest of $2,076.76. I left the big number in the calculator. I didn't round because I was just saving 2 seconds. You might have rounded and plugged it back in and be off by a few cents. But again, you won't get wrong on the test question just by a rounding error. So it's okay. Step 3, we're going to subtract and see how much of this 231206 we have left after paying the big bad lender all of that interest that they demand. And this time it's $235.30. Last time it was $233. This time it's $235. And we're going to finally, step 4, subtract that from the latest loan balance that we calculated a minute ago. And here's our loan balance after month 2, after our first 2 monthly payments. There we go. Is that a little less scary than it was the first time you saw it, maybe? Yeah. It's just a lot of steps. But really, it's essentially, for the first month's payment, it's really just 3. I guess you could look at it as 3 steps. Then to do it over again to get the end of the second month, you just repeat steps 2 and 3. Somehow, okay, I called this step 3 on the second time through, but you get the idea. Okay, we're going to do some more math about closing related practices. We're going to do that tonight. When we left off, we had just started talking about, well, I guess, let me do a review. Loan origination fee is just going to be strictly, they'll tell you it's a percentage of the loan amount. But since we're talking about loans, it's all about the loan amount. Don't mess up and do the purchase price when you're calculating origination fee. That's just going to be real simple. They're going to say the lender's charging 1% origination fee, or 1.5%, or 2%, or 1/2. And that's just 1% times the loan amount. The discount points is a little different. It's not on every loan, right? It's going to be on a loan where the borrower needs a lower interest rate. They need a lower payment. So they need it to be calculated with a lower interest rate. And that lender isn't just going to be nice and say, okay, you tell me what you need. They'll say, you tell me what rate you need, but here's what I'll tell you. This is how much it's going to cost you to get that lower rate. And it's going to cost you some points, some discount points. Guess what? Once upon a time, lenders did not have to be as transparent about these fees as they do now. We're going to learn that tonight. They are required through what's called RESPA, the Real Estate Settlement Procedures Act, to disclose the interest rate, the number of payments, if there's a prepayment penalty, and if there's any discount points. Because back in the day, lenders who wanted to win your business and beat out the other lenders you might be talking to might say, well, oh, they charge you 6%. Well, we're going to only charge you 5% rate. And if you didn't know any better, you'd be like, well, of course, let's do it. And then about 3 or 4 weeks from now, pretty much too far through the process to even try to be worth starting over, you're going to wait. You're going to realize, see it in the fine print maybe, oh, wait a minute. Your closing costs are much higher than that other lender's was. What's going on? And it's because the way they're giving you that lower interest rate is charging you 6 discount points, right? Well, wouldn't it be nice if the lender would have had to tell them, yes, I can give you a 5% rate instead of 6, but it's going to cost you $12,000. Well, now that is the way it is. Now they do have to disclose that, and they have to be transparent. They can't hide it in the fine print. Used to be when the lender would tell a borrower what all their fees were going to be, they would use what was called a good faith estimate. That's not what it is anymore. Now what they call it is a loan estimate, and it's got to look a certain way. It's a standard form. It's a standard templated form. And so every lender shows a loan estimate And so a borrower knows exactly where to look on the page. It's only a couple of pages. Where on the page is the monthly payment? Where on the page is there a prepayment penalty mentioned? So it's much easier for a borrower who's not used to seeing this stuff to recognize these important pieces of information. That used to be a big part of what I would do as a buyer agent. I would help them decipher this thing. It was like the Da Vinci Code. Would have to dig through the fine print and help them find all the gotchas that lender's trying to screw them over with. But it's easier now. I still do it. I still show it to them, help them understand it, and we'll look at it together in a little bit. But discount points still are a big deal. If somebody's promising you a really good rate, your first question as a borrower and as a broker should be, yeah, but how many points do you charge for that rate? If it is a suspiciously lower rate than everybody else is offering, it's quite likely because they're going to charge upfront prepaid interest. What are the various terms that discount points are known by? I've already given you the one. Discount points, prepaid interest. What's one more word you could see related to discount points? There it is. Yeah. Lender yield. How much is that lender getting? And we saw that presented in a certain way last night. They could ask a question like, they could say, frame it like this. The investor whose money is being borrowed wants a 6% yield, but the borrower is only able to afford payments based on a 5.5% rate. Or maybe the lender has granted them a 5.5% rate. However, how much is it going to cost that borrower in discount points? Because the investor has to get their 6%. They're requiring it. They're not giving the money. They're not making the loan if they don't get the return that they want, because that's what an interest rate is to that investor. It's a return on their money that they're loaning you. So how can we reconcile what the borrower can pay, what level of interest rate the borrower can afford, with the amount the investor requires or demands? And that involved knowing what comparison. One discount point equates to buying the rate down by how much of a percent? One discount point buys your interest rate down by how much of a percent? Now, that's not the same question as how much does a discount point cost. Those are two different things. There we go. I'm seeing it pop up now. Let me share it with everybody. There we go. Yeah, let's look at it this way. One discount point costs 1% of the loan amount, yes. So for every different loan, the discount points cost different. They're based on whatever the loan amount is. But then the next question is, how much does that discount point lower the rate? Because the cost of the discount point is not the same thing as like my interest rate is 6. Oh no, it's 5.5. How much it lowers the actual interest rate by is 1/8, as so many of you have said, also known in the decimal version as 0.125. And so in this case, where we need to find out how many discount points to get the rate lowered from 6 down to 5.5, that means we need to find out how many discount points do we need to buy the rate down by 0.5%. Well, our question is, how many 1/8 are in 0.5%? We could do it a couple of different ways. What if we did it this way? This 0.5 divided by the 0.125. That reveals that it's 4 discount points. Another way we could do it is to say 0.5 times 8. That might be easier to remember. If you just multiply the difference in the rate that you got versus the rate that you want, right? In this case, 0.5%. If you just multiply that times how many eighths are in 1 point, there's 8 of them, it's the same answer. So whichever way you want to do it, this way, dividing it by the decimal version of 1/8, or multiplying it by the number 8, which probably, now that I think about it, is a little easier to remember, that shows us how many discount points we need. Now that we know how many discount points are needed, we need one more piece of information. What's the loan amount? And if the loan amount is $500,000, how much are those 4 points going to cost? %4 of 500,000, huh? So for the low price of $20,000 on your $500,000 loan amount purchase, you could turn your rate from 6% all the way down to 5.5%. See how those things work together? How the cost of a discount point is not the same as how much it lowers the rate by. Those are different things. Lowers the rate by 1/8. For every discount point, it lowers the rate by 1/8. So when you find out how much lower the rate needs to go, how much lower the borrower needs it to be, multiply that by 8, and it tells you how many points need to be given to the lender in cash. Because the lender doesn't care who pays for these points, by the way. It could be the borrower themselves. It could be the builder or a seller. In a more competitive market where sellers are needing to work harder to get a buyer's attention, a smart seller would say, hey, I could pay toward your closing costs, Mr. Buyer, or I could pay towards some discount points to get your rate down. In the last 6 months, the rates have gone up pretty significantly, certainly in the last year. And so that's already been a tactic that sellers and smart listing agents have implemented. They've said, hey, seller, if you want to help overcome the fact that less buyers are out there buying, how about we contribute some money toward the buyer to help them get a rate that's closer to what they used to have access to? Let's get it down from that 7, get it down closer to 6. If you'll pay some dollars and tell them you will, that might get their attention and make them pick you over another seller, over another listing. So that's how discount points could actually show up in the market. And then finally, we left off with qualifying math. What does a lender do to decide if you're going to be a good risk? If you can qualify for this mortgage? They look at ratios, what's called qualifying ratios. And on a conventional loan, the qualifying ratios are what? Do you remember we barely looked at it right before the end? The front end ratio versus the back end ratio. What were those two? There you go. Yeah. 28% and 36%. When we talk about the 28%, we call it the front end ratio, and that's talking about which thing, what needs to be no more than 28% of your gross monthly income. What is it that cannot exceed 28% of your gross monthly income in terms of the loan? You got it. That monthly principal and interest payment. The thing that we use the loan factor math to calculate, by the way, right? It's kind of coming back around full circle. We can see what the rate is. We can see what the duration of the loan is going to be and get a factor and come up with what our payment's going to be for a given loan amount. But then the next question is, does that payment fit you, the borrower? Sure, you know the payment's going to be $2,350. I just pulled from air. But does that fit your budget? Does that fit your real life situation? And if the payment is indeed going to be, I just made this up, $2,350, if that's the monthly P&I, and we divide it by 28%, that tells us that our monthly gross income needs to be about $893. What did we just do? We took that monthly P&I. We know what that is because we know that we want this house over here on ABC Street that costs $411,000. And that house at today's interest rate is going to result in a P&I payment of $2,350. Then we need to figure out how does that relate to you, the borrower. And what we do know is the lender, if you want a conventional loan, is going to require that $2,350 is not more than 28% of your monthly income. So therefore, what does your monthly income need to be? We just divide it. $2,350, the P&I payment divided by that front-end ratio, $83.93 in this case. But as they say on late night TV, that's not all. There's something else. What else does a lender care about? It's not all about the principal and interest. Oh, by the way, I left something out. We would also need to factor in the T, and the I. It'd be an entire PITI. So really, to do it properly, we know the P&I is $2,350, and then we also calculate the taxes and insurance and add them in there together. Let's say that's another $500. So the total PITI would be $2,850. Now let's divide that by the 28%. So now what you really need is $10,179 per month. But that's all about the PITI, 28%. What about this back end ratio? What additional expenses do we need to consider? You got it. What other kind of debt? Your other debt. What kind of other debt? Things like car payment, recurring monthly debt, credit cards, student loans. Let's say your car payment is $350 a month. Your credit card payments every month are $400 because you're special. It's not utilities. It doesn't happen to actually be utilities, so that's cool. But it's that recurring monthly debt. So that's another $750. And if we add that to this $2,850, now what we pay every month between the future PITI that we're going to have if we can get this house, plus what we've chosen to pay or what we've chosen to have based on our choices, is $3,600. Now, it just coincidentally was that number. Divide that by 36%. And wow. That's weird. Make sure I didn't screw something up. Yeah. $10,000. So you would need to make what in order to qualify for this loan per month? What kind of monthly income would you have to qualify for this loan? The bigger one, right? You got it. Whichever one's the bigger one. Usually it's the recurring debt one, but it doesn't matter. Whichever one's the bigger one is what you're going to have to qualify for both the front end and the back end ratios of that loan type. In this case, a conventional loan. Conventional, typically 28-36. FHA, we'll get it to in a little bit. That lets you go up to 43% on the back end ratio. So that's a little more forgiving. Lets more of your monthly payment go toward your house payment. So when we calculated the P and the I a little bit ago and came up with 2350, and then I realized, oh wait, we need to put taxes and insurance in there. That's what the lender does too. They're like, okay, you're going to have to pay your taxes and insurance. If you don't pay your taxes, the government can take your property. If you don't pay your insurance and it burns down, the collateral is gone. So we need to have both PI and TI. And so we call the taxes and insurance the escrow portion because it lives in an escrow account with the lender so that when those bills come due in the given year, the lender has it available so they can stroke those checks and send it in, gets paid. That lender would much rather they handle it for you and then charge you 1/12 of your taxes every month added onto your P&I payment and 1/12 of your insurance every month. Let's look at this one. Here's our PITI, and that's got to be the front end ratio of 28%. And then when you factor in expenses, that can't exceed 36%. So if we take our PITI and it's $1,500, how do we figure what your max monthly income or what your minimum monthly income needs to be? If we know our principal, interest, tax, insurance is $1,500 for this house that you've picked. 1,500 divided by the 28%. In this case, we're referring to it as a decimal, but it's the same thing as putting 28 and the percent sign is the same thing as putting in 0.28. So when you do that, you at least need to make $5,357 a month. But when you add in another $700 of expenses, makes your total monthly outlay with that future house payment plus your current recurring debt expenses of $2,200. When we divide that by the back end ratio, we need to make $6,111. So to qualify for this loan, that borrower needs to make at least $6,111 per month. Let's take a little recap and look at what I call a monster question. So this is a question that has given you a bunch of information. And here are 7 different potential questions they could ask with a paragraph like this. They might very well give you all of this information and only ask for number 3 down here. They're going to test you on what you don't need to know as much as what you do need in order to do a calculation. So the buyer's purchasing a house for $425,000. To buy it, the buyer was going to use a conventional loan with a 90% LTV. Another way to say that is a 90-10 loan ratio, 90% borrowed versus 10% down payment. The interest rate they're getting is 4.5% over a 30-year term. The lender's charging a 1% origination fee, not weird, not unusual, and 3 discount points. The municipality or city, town, basically, in which the property is located, taxed properties at 14 mills based on 75% of market value. They're just throwing it all at you. Everything we've ever looked at for calculation is in here. The commission payable is 5.5%. That's what the listing agent is charging, 5.5%. They're going to share that with the other firm if another firm brings the buyer. Attorney fees and miscellaneous expenses are $4,000. And so given all of this information, let's go down through the list here and calculate these things. How do we come up with the commission? What's the commission going to be in dollars based on this information? The commission. But change the answer. Change the chat, So you just plug that right in when you're ready. Just going to bring up my little calculator down here so we can look at some things. Okay, good. All right, commission. Let's see. What do we have? Now, good point. Somebody in the chat says if it were split in half with another, and they went ahead and did that. But if they want that, obviously they'll ask for it. So don't read into it. I wouldn't want you to do more than you have to. So all we know and all they've referenced is how much the total commission is. It's total being charged is 5.5%. So what we're going to do, and I think most of you got that, no problem. What is the commission based on? It's 5.5% times what? That sales price. You got it. That $425. So $425 times 5.5%, $23,375. And that's what I'm seeing up through there. $23,375. Yep, there we go. What about tax value? What do we get for tax value? How do we do that one? Which pieces of information do we need for tax value? They gave us mills. They gave us 75% of market value. Do we need the mills? All they're asking is what the tax value is. They're not asking how much the tax bill is, right? Number 2 is just what is the tax value, and that's just going to involve the purchase price of $425 and what percent of the purchase price is going to be the assessed value, which is 75%. So that's it. 425 times 75% means the tax value is $318,750. That's what number 2 is asking. Now it leads into number 3, because number 3 is saying, yeah, okay, then what are the annual taxes? Now you do need the mills. And you already have the tax value because we just did it. So number 3, we're going to take that $318,750, multiply it by 14 mills. But we do need to divide those mills by something, divided by 1,000. So let's take our 14 mills divided by 1,000 and multiply that by the tax value. So our annual taxes are $44,622.50. We okay? All coming back to you? I still have the chat set to private, so feel free to let me know if you need something different or if you didn't quite grasp it that first time. Okay, what about the loan amount? Number 4. How do we get the loan amount? We need a purchase price. If we multiply our purchase price by that LTV, it's 90% of the purchase price. So our loan amount is $382,500. $382,500. We okay? And next was annual interest. Oh, we're old pros at that for the last 24 hours. We've had that nailed down. Annual interest. Well, good thing we just figured out the loan amount because we need it for this. $382,500 times what? An interest rate of 4.5%. So our annual interest, $17 to $12.50. Great. Good job. Loan origination fee and discount points together. Another case where they're asking for both of them together. So what was the origination fee? 1%? Okay. OF, 1%. Discount points are 3. So you could calculate both of those individually and add them together. But to save time, you could also realize that that means 4% of the loan amount. And so if we take 4% times that 382,500, that's it, one step. So discount points plus origination fee combined is $15,300. Whichever way you feel comfortable. Oh no, not this one again. Loan balance after the first payment. We got it. No problem. Loan balance after the first payment, number 7. Uh-oh. Pencil problems. Okay. Step 1. Let's get our monthly payment. Did we figure that out? No, we haven't done that. Okay. Do we know it? Okay, we know the interest rate and the loan term, but we don't have a factor number. Let me see if I can look up that factor chart. 4.5%. 4.5 for 30 years. Oops. Oh boy. Looks like a 5.07 factor. So that's what we'll work with, 5.07. And our loan amount was $382,500. Oops, I forgot to divide by 1,000. No problem, I'll do it right now. So our monthly principal and interest is $1939.28. And that's not going to change. So that's good. Step 2, figure out how much of that is going to be interest in that first month. We need our loan amount again. But this time we need our interest rate, which is 4.5%. So our annual interest is $17,212.50. Divide that by 12. So our interest this month is $1,434.38. We're going to subtract that from this. And that shows us that our principal is coming down by $504.91. So we're just going to subtract that from that $382,500. And it's somewhere around $381,995. How we doing? I went kind of fast, but I feel like you're ready for that. But let me know. And there's the answers. Let's see if that's what we got. Looks like it. I erased the first two, but that's about right. Yep. All that looks familiar. I didn't do a final on this answer choice. I needed to have subtracted that 505 from, that's what we did last, just then. So we got the 381 number there. So look how much you can do now. Look at all that math. Tell me in the chat if there's something that you want to review or that's confusing. Number 6 was, the combined origination fee and the discount points. Let me do it the other way. If we do the origination fee of 1%, we're just going to do that times the 1% of the loan amount, right? 382.5. And that's easy. We can just move a decimal. So that's 3825 is how much 1% is. And then we do 3% of the same thing. That's 11,475. Then we can just add them together to get the 15.3. So that's always the easier thing. But all I did up here the first time through was took the 1% origination fee and the 3% discount points and just said, well, that's the same thing as saying 4% of the loan amount. So I just did a little calculation differently. Can you see it any more clearly if I zoom in? Kia. And then any question? What question? Oh, that's the broadband thing. Okay. Let me do this. Well. Oh, that's the next thing. Okay. I'm going to put it in the chat. And there's a little screen grab. Maybe, hopefully that shows up better. And you can kind of use it. But did you have a specific question about any of it? It might be tough because you didn't see the question itself, but which one's giving you trouble? Okay, good. Right. So knowing which of all of that information you need for each individual question. I gotcha. Right. We'll talk about that, but let me give you your break. And when we come back from break, we'll kind of dissect it a little bit more. And I'll see you back in 10. way back together. Okay, let me see if I can share this with you a little better. There we go. See if I can flip this around. There we go. Is that easier to see? So, obviously, they've given us a ton of stuff. The typical question is not going to be quite this massive. But this is just an example, and it's just an exercise in how to identify which things you need to know to get which things they're asking for. And that is for commission. To do commission, you're just going to need to maybe even make a list. For commission, sale price times commission rate, right? For tax value, the percent of market value, in this case, 75% of market value. So the purchase price, sale price of $425, and that percentage of it that is going to be the assessed value. For annual taxes, it's going to require the tax value or the assessed value and the tax rate. For loan amount, it's the purchase price and the loan to value ratio. In this case, 90%. For annual interest, it's the loan amount times the interest rate itself. In this case, 4.5% interest times the loan amount. And then origination fee is about the percentage of the loan amount that they ask you for. Discount points, same thing. However many discount points is however many of a percent of the loan amount that you're going to need to use. And then loan balance after the first payment is the big monster one, right? And it's going to require using the loan factor and the loan amount to get the monthly principal and interest, and then the loan amount and the interest rate to get the annual interest and then the monthly interest, and then subtracting. So that's just going to come from doing a lot of different math problems over and over again. No, they don't let us release the slides, I'm afraid. So you can't do that one. Okay, next one. Let's look at this exercise. And I'll read it in case it's not coming through clearly. Make a little space here. Okay. This we're talking about qualifying for a mortgage. So the buyer is discussing obtaining a loan with the preferred lender. I know I can do the same thing. I could do a screen capture again. There you go. In the chat is a screenshot of this slide. Buyers discussing getting a loan with the lender. During the qualification process, the buyer learns that to obtain a loan, they have to have sufficient income to meet debt to income ratios of 28% and 36%. No surprises there. Their current income is $15,000 per month. Using the above information, first question, what is the maximum amount the buyer could pay for monthly principal, interest, taxes, and insurance? The maximum amount the buyer could pay. So what do we know? We know that they make $15,000 a month. And we know that they're asking for the front end ratio. They're asking for the one that's maximum, or how much could the buyer afford if they make $15,000 a month. That's going to require taking their monthly income and finding out what 28% of it is. So they're $15,000 per month at 28% means that the most they can afford to pay for the principal, interest, taxes, and insurance is $4,200. Because that's what 28% of 15,000 is. The next question that I'm kind of blocking, but I'll just read it to you. Yeah, it's typically going to be just the conventional version. Somebody's asking, will they tell you the 2836? Typically, yes. They're not going to go much further than that. They're not going to get into other ratios usually. The next question is, what is the maximum amount the buyer could pay for total monthly expenses? And that one is going to basically be the back end ratio. 15,000 is their gross monthly. So what is 36% of that? And that is $5,400. So the most they can pay toward both their principal, interest, taxes, and insurance plus their recurring monthly debt combined is $5,400 in order to qualify for this loan. And then the third question here is, how much total monthly recurring debt payments could the buyer have? Well, if the most they can pay for PITI is $4,200 and the most they can pay for both that plus the recurring debt together is $5,400, RD just means recurring debt. That's what we're looking for. That's what they're asking for. How much total recurring debt could there be? And that's just going to be this, right? Just do that subtraction. 5,400 minus 4,200 means that the buyer can have $1,200 a month for credit cards, car payment, student loans, other kinds of recurring monthly debt. Is that pretty clear? Here's the way it looks. Legibly so that you can read it better. Okay, what about this one? This one's a little different. A buyer is qualifying for a new loan. Hang on one second. Let me screen cap this with the answer so you'll have it. There you go. Okay, buyers qualifying for a new loan using debt-to-income ratios of 28:36. If they have annual property taxes of $3,600 and homeowners insurance of $1,200, their current monthly recurring debts are $400 for student loan, $500 for credit card, $350 for car payment. They have a $120,000 annual income. How much money is left for principal and interest payments with all of this other stuff factored in? So what we have, one second, lost my cursor. There we go. If we're making $120 a year, how much is that per month? It's $10,000 a month, right? That's their max gross monthly income. Okay. What else do we know? We know that out of the PITI, we know what the T is. Their taxes are $3,600 a year. So if we divide that by 12, that means $300 a month for taxes in their house payment. And then the insurance is $1,200 a year. And if we divide that by 12, that's $100 of their house payment for insurance. What else? We know that of this $10,000 a month, they need to qualify with the 28:36 ratios. And so what is 28% of 10,000? No more than $2,800 a month can be toward their PITI, and no more than $3,600 a month can be toward their total of everything together. What else? The recurring debt. We've got this recurring debt, and it was some credit cards of $500 a month. It was car of $350, I believe. And it was student loans of $400. So when you add all that up, is that it? Yeah, that was $1,250. That's recurring debt. So the total of $3,600 minus that recurring debt left $2,350. That $3,600 was everything together. Make a little space here. And so if we subtract from that $3,600 the amount of recurring monthly debt, that's $2,300 a month. And then what else? We still need to take out the $400 for taxes and insurance. We take that out. That leaves us finally with $1,950 that can go for principal and interest together. Oops. There you go. Let me See if this will work. Do a screen cap. There you go. And then there it is with oops. Oh. Here we go. Let's see. Had a question. Why wouldn't we subtract from their monthly income? Okay, so it's not about the monthly income. It's about the maximum of their monthly income that can be paid for both principal, interest, tax, insurance, plus recurring debt. But I get it. Good question. But what we're asking, not that they can afford it with their monthly income, but can they afford it within the guidelines, requirements of the lender? And so the most of their monthly income that they can use for all of this is the $3,600. Lender wants to make sure that they're not maxing out. That'd be if they had to spend all or too close to the $10,000 every month on all of these things, then the lender would feel unsure that they would be able to maintain that and keep making their house payment, and therefore be more susceptible to default, falling into foreclosure. Okay, let's talk about loan types. Get away from math for a little bit. You okay with getting away from math? So how does this whole process work in this country? Well, there is the Federal Reserve System, Federal Reserve Bank. It's got 12 banks across the country, 12 that all work to, the Federal Reserve is what kind of helps regulate the economy, regulates the flow of money. It controls what the interest rates are, because your bank that you deal with borrows money from the Federal Reserve at a lower interest rate than they loan money to you, and they make a profit. So the Federal Reserve's rate is the rate that they loan money to your bank at, and then that affects the rate that your bank's willing to loan you the money for, whatever the money might be used for, whether mortgages or cars or whatever. So the Federal Reserve System is in place to kind of help us avoid catastrophe, like 1930s. What happened in the 1930s? Why was the Great Depression so bad? Well, once upon a time, people would make deposits into their bank, right? They would take their money from their paycheck, take it to the bank, stick it in the bank. Security, right? They wouldn't have to worry about having cash stolen from them because it was there in the vault. Well, the bank realized over time, wait a minute, all these people bring us their money to hold for them, and it's just sitting there, completely useless. What if, and what they never do is pull all of their money out at the same time. So the bank owners started feeling pretty confident that nobody would ever come and ask for all of their money all at the same time. Surely not every single customer. And so they felt more confident loaning out bigger chunks of all that cash. They made loans. If they could make loans with that cash, why are they interested in making loans to people that we've been talking about? Why would a bank want to do that with this money instead of keeping it safe and sound in the vault? You tell me. Yeah, interest. It's all about that interest, right? The velocity of money. Moving that money is where they make money, not sitting in a vault somewhere. So they just got carried away, and they started loaning out more and more of that money, and all of a sudden there wasn't quite as much money in the vault as there should be. There were no requirements of certain amounts in reserve that they had to keep on hand, because the idea of everybody, every customer coming in and demanding all of their money at the same time was so ridiculously remote. How would that ever happen? Until it did. Great Depression happened. A lot of things went wrong. People made a run on the bank. A lot of people came to the bank and said, I want my money. And guess what they had to say? We don't have your money. We loaned it out so that we could be greedy and make interest on your money. And that kind of led to the big collapse. Well, we learned from that. We learned from that mistake. So now part of the Federal Reserve duties and responsibilities is to set limitations on the bank as to what they are allowed to loan out. How much of the deposits can they loan out? So that's what it means here. Bullet point 3 sets reserve funds for banks. What's the maximum the bank is allowed to loan out at any given time? That's part of what the Federal Reserve dictates as well. And the point is just to keep the economy healthy. There is some politics involved because the chairman of the Federal Reserve can be appointed by the president. And there, I think a year, maybe 2 years ago, Biden had to decide, do I let the current guy stay or do I replace him with someone else? And there was talk. It was a lady, I can't remember her name, but Jerome Powell is the current guy and had been the current guy. And he ended up having Powell stay in the position, but he could have replaced him. So there's some of that involved in the mix too. But the Federal Reserve is there to kind of keep the economy flowing nice and healthily and smoothly. And that's going to depend a little bit about some people's opinions about what it takes to make a healthy economy. So the Federal Reserve loans money to your bank at an interest rate that you can't get. It's a lower rate than you can get. And then your bank loans to you at a higher rate, right? So that's sort of how that hierarchy goes. Now, let's talk about the two different main kinds of mortgage markets. Primary and secondary. And all this is referring to is how when you want to buy a house and you go talk to a lender and that lender says, okay, well, how much do you want to buy? And you say $450, and they say, well, that's going to be this amount per month, and let me see if you qualify, and what do you make in a given month? Show me your pay stubs and prove it, and let's see your tax returns, and let's make sure what your credit score is. Is it healthy? Have you proven by your past history that you're a good credit risk, or have you had trouble paying your bills? And so that's going to affect, number one, whether the lender will even give you the loan, and number two, if they'll give it to you, how much interest rate will be. Because the lower your credit, if they'll still give you the loan, they'll give it to you at a higher interest rate. You have to pay for your sins, right? You have to pay for a less than ideal credit score. That's just the way it works. But that process of you going in there and applying for that loan, you and your friend and your neighbor, all that street level one-to-one kind of relationship, that is the primary mortgage market, where each loan is made individually. Hundreds and hundreds, thousands and thousands of loans. But you remember that word that we learned that's in the promissory note? How it needs to be a negotiable instrument? How you sign that promissory note and that stands for the fact that you owe that lender some money. You owe that bank money and you're going to repay it at such and such interest rate over 30 years or whatever. Because you have agreed and acknowledged that that is a negotiable instrument, that gives them the right to bundle your loan up with a bunch of other people like you in terms of credit strength, financial strength, and package them in a big chunk and sell that big bundle of mortgages, of similar risk mortgages, off to other lenders, off to another lender who will give them a big chunk of money. Now they can go make more loans. So the fact that that promissory note is negotiable is what creates and allows the secondary mortgage market to exist. Because the secondary market is the behind the scenes buying and selling of big bundles of loans. back and forth. Why would a bank want to buy a whole bunch of loans, yours included? Because they want to have that income over the next 20, 25, 30 years. They want that slow and steady interest accumulation over the years, because it's going to be a lot of money if they're willing to wait. So why would the one who sells that package of loans to them want to sell them and not have them for 30 years? Because they want the money now. They want to get a chunk of money now so they can go out and make more interest on new loans, create new loans, and it's a cyclical process. So that primary mortgage market is, again, that individually loaning of money to each individual borrower. And the word for it is originating loans. Origination. A loan originator is that person you talk to and submit your application to. That's the loan originator. They're starting it. They're creating it. Lending the money directly to consumers. Where does this money come from? All kinds of places. We kind of talked about the insurance companies. What do they do with those premiums you pay? Well, part of it is they invest in the mortgage market, and they invest that money in home loans, making that money available to people to borrow to buy homes. Why? Because it's pretty darn conservative and safe and not too risky. We screwed it up. They screwed it up leading up to 2008. They got a little risky with it. They didn't stick to certain guidelines. They made loans to people who didn't have strong enough credit, strong enough indication that they have been able to pay bills on time. So they relaxed their requirements, and so it was called the subprime mortgage market. That was one thing that kind of exploded back then. They made loans to people that didn't end up paying, but the idea back then was, surely someone won't let their house go into foreclosure. They'll let their BMW get repossessed before they'll let their house get foreclosed, but that didn't turn out to be so true. They'd rather keep the Beamer and let the house go, right? And it was a lot of other things too. It was just a sort of a blatant disrespect of just money in general. Lenders were making money hand over fist. Everybody wants to own a house, so they were giving money to people to own the houses, and then they got in trouble. One other thing that would take place, I think I might have mentioned it, were stated income loans, stated income. And for 1099 earners like us, real estate brokers, 100% commission, we don't maximize our tax returns to show that we're making a lot of money. We use every legal means necessary and available to us to show that we're as broke as possible so that we can pay as little in taxes as possible. Well, guess what? That backfires when you want to qualify to buy a house. And the lender is like, wait, you can't afford this house. And you're like, well, that's just what I show on paper legally so that I can pay as little in taxes as possible, because we all have the legal right to minimize our tax burden. But the lender's not about that life. They're like, well, you're just going to have to suck it up, and you're going to have to not enjoy all of these deductions in a given year so that you can prove to us that you can, in fact, afford this house. So you kind of have to eat it when you're ready to buy a house every few years. If you're 1099 and you have to maybe redo your taxes in a way that shows more income instead of taking every single deduction you possibly can. Well, one way around that was what was called a stated income loan. Yeah, it does. I see that question in the chat. Pensions do, of course, but disability as well. And in fact, somebody asked, does disability count as income? Also, if you wanted to keep your house instead of selling it, whatever you can make in rent as income from your house, a portion of that, and I think as much as 75% of that potential rent is also toward your income. They include that to qualify you for the purchase of your next one. But most people would rather cash out and sell it and get all the money out, pay off that loan, and then put it toward down. But anyway, the money being loaned to people for home loans comes from all of these different places. Commercial banks, credit unions make such loans, pension funds, like a police union pension fund from New York. The police and firefighters, that's a whole different ball game in New York compared to down here. They get paid really well. And so they have like a pension fund that somebody's in charge of. Some financial planner is like, where are we going to put this money while it's growing, as we're taking it from their paychecks? And then when we have to pay it out when they turn however old they need to turn, I guess at 20 years, what are we going to do with it in the meantime? Oh, let's invest it in the mortgage market. Let's give it to people to make loans to buy homes. Investment groups, mortgage brokers, mortgage bankers, endowment funds, insurance companies, credit unions will typically hang on to the loans that they make. A lot of times, a good reason to use a credit union for your home loan is that they won't sell it to another party, another bank. And if that's something that matters to your client, just some advice you could give them. Are you a member of a credit union, like a state employees credit union? There's a handful of them out there. Then that might be a way that you could be sure that they're never going to sell your loan, and you know that you're always going to make your payment to the same place. So all of these places fund loans. And then that secondary mortgage market is when money is funneled back into the primary market because it's packaged up and sold off to other lenders who do want to keep those notes for the entire duration. Now, when it comes to this secondary mortgage market, think of it sort of like a flea market. Everybody ever been to a flea market? People are just kind of setting up booths and selling things that they make from home, or jams and jellies or fruit or something. Well, the secondary mortgage market is composed of a few different specific groups. The biggest one is nicknamed Fannie Mae. If you've ever heard the term Fannie Mae, it stands for Federal National Mortgage Association, FNMA, Fannie Mae. That's the biggest one. That's the oldest one. It's been around forever. And in the Fannie Mae market, they buy and sell all kinds of loans, conventional, FHA, and VA. They buy and sell all of them. FHA and VA loans are kind of unique. They are in place because the government says, let's help people who can't manage to get approved for a conventional loan. Let's give them the chance to buy a house, to have home ownership. If they can't afford the down payment required for a conventional loan, let's give them a way to have less for down payment. And so an FHA loan lets somebody put as little as 3.5% down payment to buy a house. Conventional is typically minimum 5% down, although there are some specialty programs that'll let you get a little lower than that. But typically, if you have less than 5% for down payment, you're going to need to consider an FHA loan. The other advantage of an FHA loan is your credit score. If you don't have good enough credit to qualify for a conventional loan, then FHA allows you to have a little bit lower score. So FHA loans, the reason they can accommodate a lower down payment and a lower credit score is the government stands behind them. The government insures them. The government insures FHA loans. Write that one down. FHA loans are government insured, and circle insured. The word insured, if you see government insured, you need to think that's an FHA loan. A conventional mortgage is not government insured, but an FHA one is. And then another government-related loan that we deal with is a VA loan. Stands for Veteran Affairs, right? They are for military veterans, military active, and their spouses. So if the test question said, there's no yes or no, but if it was something like, is a VA loan only for military? Then the answer is no. A military spouse can get a VA loan also, right? And a veteran getting a VA loan, they could choose to let a non-veteran or non-military person assume their VA loan. So it could end up being a VA loan held by somebody that's not a vet. Tell me more, Marcus. Why does what matter if the terms have to be the same? That was a few minutes ago. I apologize. Oh, that's true. Okay, I got you. Yeah, I was going to mention that myself. Well, why would anybody care? But some people do. Some people are just, I don't know, maybe they had a bad experience. Maybe they lost track of who they were supposed to send their payment to. I've heard those as complaints from people. Occasionally I run into a buyer and they're like, ugh, it was so annoying. They sold my loan and it really just bothered them. And I'm like you. I'm like, who cares as long as you make your payment and that part doesn't change. But it does bother some people. And if it does, that's the one way that they could find a solution. But you make a good point. I don't know why you would care. The VA loans for veterans and their spouses are not insured by the government. Here's what you need to know about them. They are guaranteed. They are government guaranteed. So the word guarantee means VA loan, guaranteed by the government. The word insured by the government means FHA loan. They're trying to encourage home ownership. That means they're making them available to people that don't have as much for down payment or credit score or both. And so they want to make sure that those borrowers are set up for success. As a result, when it's an FHA or a VA loan, the appraisal is stricter. The house has to be in better shape than it can be when it's a conventional loan. So here's the process of just purchases in general. We've kind of touched on it already. The offer is made. It's eventually accepted. Something's accepted, a counteroffer. We go under contract. The buyer is probably getting a loan. They're going to apply for that loan. They're going to pick a lender, try to get a conventional FHA, VA, whatever. And that lender, that loan originator, is gathering documentation, passing it on to the next level, which is the processor. And that processor is really trying to accumulate every possible thing that the loan underwriter needs in order to consider whether they'll give the loan to the borrower. Well, part of that process is determining, is the property worth it? Right? Makes sense. If you're loaning somebody money to buy a property for $300,000, you want to make sure it's worth $300,000 and not, oops, sorry, it's only worth $250,000. So the lender makes the loan, for instance, like a 90% loan to value ratio. The lender will loan you 90% of the $300,000 purchase price. They're not going to guarantee that or promise that they're going to loan on the purchase price if it turns out it's not really worth $300,000. How do we determine what it's worth? How does the lender make sure they're confident in what it's worth? Tell me in the chat. How could the lender be sure? Because there could be a couple of real estate agents involved, both of whom did some research to see what they think it's worth. Are they going to believe the brokers? No, they are not. They're going to believe the person who's even better than a broker at determining how much something is worth. That person is called an appraiser. Don't mix up an appraisal with an inspection. Both of those things are typically done during the due diligence period, but the appraisal is all about how much is it worth? Is it really worth what they've agreed to pay for it? And if it's not, we have a problem, because the lender is only going to loan 90% of the lower number. If it doesn't appraise for the $300,000 purchase price, but only appraises for $280,000, then the lender's not going to loan 90% of $300,000. They're only going to loan 90% of $280,000, the lower of the two. So the lender wants to know for sure what it's worth, and it's not based on the word of either of the brokers. It's going to be based on an appraisal. How does the lender hire the appraisal or get it done? They are not allowed to talk to the appraiser. Because imagine this. It's in the early 2000s. A lender has a go-to appraiser that they hire every time, because back then they could. They'd reach out to that appraiser and say, hey, we got another one. Go do your work. Tell us what it's worth. The appraiser comes back and says, the best I can come up with is it's worth $290, not $300. And the lender says, you know what? This is a repeat customer, this borrower. We really need to make this one happen. Are you sure about that $290? And sometimes that lender might have kind of leaned on the appraiser a little bit and said, I really hope you can maybe do some numbers again and come up to the 300 because we really want this loan to go through, which basically would cause, what is that lender saying? They're telling the appraiser, help me commit loan fraud, because it's not the lender whose money is being borrowed. It's that investor, that pension fund, that mortgage bank, mortgage broker, that insurance company, whoever the money's coming from is not the one who's creating this loan. The one who's making the loan is just following guidelines and combining. They're pairing up a borrower with an investor. And you never meet the investor. You just know that they are willing to loan the money if you can qualify this borrower to loan it to. And so there was a lot of loan fraud. And there still is some loan fraud. There was so much at one point that the FBI set up a satellite office for loan fraud in Charlotte because there was so much. And it would be a dirty appraiser who's willing to say, well, it's really worth $280, but I'll say it's worth $300, wink, wink. And a dirty lender, both of whom are trying to defraud the investor and say to the investor, see, we did everything we're supposed to. It's worth it. Go ahead and fund this loan. Send the money, wire it in, and let us loan this money. And then it wasn't a borrower who could handle it. It was maybe a subprime, lower credit risk. And so the borrower inevitably defaulted. And then it had to go to foreclosure. And that's just, so it could be a dirty real estate agent, a dirty attorney, dirty appraiser, all working together to make this phantom amount of loan amount compared to what it really was worth. And they'd split the profits. Loan fraud, by the way, is kind of a big deal. Loan fraud carries with it a maximum prison term of how many years? Have you reached that part in your reading? How many years do you think if a mortgage duration were to be put into a prison term? That's how I remember it. How perfect would it be? And that's exactly right. Loan fraud carries a 30-year maximum prison sentence. Loan fraud. What could that be? Saying it's appraised for something it's really not. Not putting every single number and dollar on the settlement statement that everyone signs at closing. Having the seller pay the buyer secretly because the buyer really can't afford it, but they need an extra $5,000, but we don't want the lender to know or they won't qualify the buyer. So let's just let the seller slip that $5,000 to them in an envelope in the lobby of the closing attorney. Loan fraud, loan fraud, loan fraud. It could also be, have you ever heard of a gift letter? A first-time home buyer needs to get a gift from mom and dad, and they say, hey, Mom, really appreciate you loaning me the money. I'll pay you back when I get my tax refund. Well, if you're the broker and you heard them say that, and what it was supposed to be was mom and dad signs over the $5,000 or $10,000 as gift money with a gift letter, what's that letter supposed to say? It says, I promise, I swear that this is a gift. I don't expect it to be repaid. You would have just witnessed the intention to commit loan fraud. They didn't do it yet, but you would have overheard the intention if they said, hey, Mom, thanks for the loan when it was supposed to be a gift. Not a good place to be. That's loan fraud. And who's going to get thrown under the bus if somebody were to get caught and say, well, she heard me say it. Why didn't she speak up? Mom and son are going to team up, right? 30-year maximum prison sentence, $1 million fine. It's a big deal. We're talking Martha Stewart prison. Martha Stewart served her time in West Virginia, and that's probably where somebody could end up in such a situation. Anyway, So back to the secondary mortgage market. Fannie Mae is the big one that handles all loan types. Fannie Mae would rather not do FHA and VA loans. They would rather not have those loans packaged up and sold back and forth in their marketplace. But they allow it because of this second one called Ginnie Mae. Ginnie Mae stands for Government National Mortgage Association. Because Ginnie Mae exists, that's where the FHA and VA loans are handled. And that means since the government is guaranteeing the VA loans and insuring the FHA loans, because the government is backing those specific loan types, Fannie Mae says, well, in the event of a default, the government's going to step in and help alleviate the loss. Therefore, yes, okay, we will also buy and sell VA and FHA loans along with conventional ones. If it weren't for the government involvement, they wouldn't touch them. VA, FHA loans would not be a part of Fannie Mae if it weren't for Ginnie Mae stepping in and saying, yeah, okay, we'll vouch for those too. And then we have this little brother, Freddie Mac, Federal Home Loan Mortgage Corporation. It's sort of a smaller version of Fannie Mae. It covers things like savings and loans and some other kinds of institutions, and we'll get to that in a minute. But let's first have our break, and I'll see you back here in 10 minutes. Welcome back. Let's make our way back together. Let's see in the chat, investors could lose out if a bunch of people pay off loans early. True, but for one thing, if they're loaning money for FHA or VA, they know that's part of the deal. They're not allowed to charge a prepayment penalty, right? Secondly, I guess people are going to pay them off early either through selling them or through refinancing, and that just frees up their money. Yeah, they're not going to make interest on that particular loan anymore, but they'll just turn around and take that money they get paid off early and make new loans. So I don't think they're sweating it too bad, but that's just cost of doing business kind of thing. So these mortgage markets, this Fannie Mae one, Fannie Mae is what we're talking about here. I don't have it. I don't know why it went away. But Fannie Mae purchases both conventional loans as well as FHA and VA loans. It's the oldest and largest of all of them, of the markets. It establishes that market for the buying and selling of these loans back and forth. Fannie Mae is so big and old that it helps develop housing policies, government housing policies. It also establishes underwriting guidelines. So remember the process of getting a loan? You talk to the loan originator, that loan officer person first. They pass it off to the processor, and then the processor is trying to put it in a perfect order with all the information needed, including the appraised value, to give to the underwriter. And that underwriter is going to compare it to the guidelines that are allowable for that type of loan. And so that's what we're talking about with underwriting guidelines, the guidelines that are used to determine if they're going to make the loan to the borrower or not. That's partly what Fannie Mae does too, is help decide what are good guidelines. What makes for a good loan underwriting guideline? Something that's going to help make sure it gets paid. Make sure that you don't end up giving a loan to somebody that's not going to pay it back and require different things. That's Fannie Mae. Then there was Ginnie Mae, the Government National Mortgage Association. That's under the HUD, the government agency called HUD, Housing and Urban Development. And since the VA and FHA loans are considered higher risk loans because they allow for people with lower credit and lower down payment, Ginnie Mae works with Fannie Mae to help them alleviate that higher risk. Ginnie Mae will pay the differential created by that extra amount of risk so that Fannie Mae can feel comfortable interacting, buying and selling VA and FHA loans along with the conventional ones. Ginnie Mae also lets investors buy shares in pools of loans. So an investor could buy shares. And they will pay directly to investors too. Freddie Mac is this one. It deals with savings and loans, mortgage banks. It also pools loans and sells bonds against those loans to investors too. That's about it. Just know that there's Fannie Mae, Ginnie Mae, and Freddie Mac. You don't have to deep dive. It's pretty much what are those differences. We get more into the difference between conventional FHA and VA than we do on the test for Fannie Mae, Ginnie Mae, and Freddie Mac. We talked about the crisis back in 2008, and it was due in part from subprime failures, meaning the lenders got too aggressive in giving loans to people that couldn't maintain them. Made the subprime mortgage market, people that had credit scores and histories that were not high enough, and so they inevitably didn't pay their loan back. And so that led to defaults, led to foreclosures, just rampant defaults, rampant foreclosures. Oh, there was another kind of loan at the time that, you remember we were talking about some loan to value ratios of like 90%. If it's a 90% LTV, that means you're borrowing 90% of the sale price. These loans, how about 125% loan to value ratio? that means here's the keys and here's a check. Congratulations on home ownership. And it was just too fast and loose. If you've ever seen the movie or read the book, The Big Short, something to check out. It's pretty good. The book's always better than the movie, but the movie's pretty quick, short and sweet, and it gives you the idea, the concept of just how irresponsible banks and lenders were about giving loans to people. So it led to that big catastrophe. Let's talk about the types. If you can qualify for a conventional mortgage, that's what you should get. Even if you're a veteran, who ordinarily a veteran might say, well, why would I not get a VA loan? Because zero down payment. Well, if you don't have any money for down payment, then yes, do it. But there's plenty of vets, military people that do have money for down payment. And so just because they can qualify for a VA loan doesn't mean that's their best financial option. Even though they're a vet or military, maybe they should still go for a conventional loan, because FHA and VA loans help make mortgages available to people who otherwise couldn't get them, but they come at a price. They're more expensive. They've got extra fees. They've got other things that make them not ideal. So, if at all possible, as a broker, tell your borrower, okay, I know you're thinking about an FHA or a VA loan and you've heard about those things, but let's see if you qualify for conventional first, because that's going to be your best overall deal. It's going to be the lowest out of pocket, the lowest fees, the best rates. If you can qualify, that's usually the best choice for anybody, regardless of their situation. It's when they don't have enough money for down payment, or when they just don't have a high enough credit score, that they need to just, okay, drop back and punt, forget the conventional, let me see what FHA can do for me. A conventional loan is less risk because it requires a higher credit score, right? If you have a higher score, better credit history, the idea is you've proven that you know how to pay your bills on time. Therefore, you have proven to be a lesser risk. And if it's your money that you're loaning out to someone, you're going to probably want to loan it to somebody that has proven time and again that they pay their bills. So it also allows, since it is lower risk, it allows for a lower LTV, lower loan to value ratio. You can put you have lower of a loan amount, right? You're putting more down payment. You can afford more down payment and you have a higher credit score. It's a conforming loan, meaning it meets guidelines that are in place because you have better credit, therefore you can meet those more stringent, more strict guidelines. There are some non-conforming loans. One of them that Holly mentioned is a jumbo loan. When it's $1 million property, that's a non-conforming loan. If you're borrowing a higher loan amount to buy a higher purchase price, then that comes with it higher, a different interest rate, different levels of risk, and that's sort of a different animal. But conventional loans are lower risk to the lender because they require better credit scores. Now, the lender would rather, if they had a perfect world, if they could just demand you to do this, they would say you have to put 20% down payment. Who's ever heard of that? You have to have 20% as a down payment for a loan. Anybody ever heard of Gary Vaynerchuk, by the way? Gary V, big marketing guy. He's given lots and lots of talks, and he's obviously more successful than I am, but he had something wrong. He basically, in a couple of his talks, he said, well, you have to put 20% down payment. And I'm like, Gary, this isn't 40 years ago. Most people don't. They just don't. And the lender allows you to put less than 20% as a down payment to get a loan. So if they had their preference, though, that's what they would like you to do. So here's your sale price, whatever it is. And then here's that minimum 20% down payment. That's what the lender would like for you to put down. But a lot of people don't have that. And the lender's going to let you borrow money even if you don't have quite 20%. Maybe you only have 5%. So if you go into default, you could lose the property to foreclosure. But what about this difference here between what the lender wishes you put down and what you actually did put down? They would rather you have done this 20% right here, but you only actually put down 5. And so the difference here, they want some additional protection. The lender wants you to give them some assurance that since you're not putting the entire 20 that they would rather you have, that they get some kind of coverage, some kind of additional protection, some kind of an insurance policy. Literally an insurance policy. And it's called mortgage insurance. Anybody heard of mortgage insurance? That's what it's there for. The mortgage insurance policy is required if you put less than 20% as your down payment. Whether it's a conventional loan or a VA loan or an FHA loan, there's some kind of mortgage insurance involved. And that's what it's there for. It's there to cover this difference here between the amount you actually put down, 5%, 10%, and the 20 that they would rather you have put down. Why do they care about 20 so much? Any ideas why the lender wishes you would put 20% down? The idea is sort of like skin in the game, right? The idea is if you have 20% of your money in this house right off the bat from day one, you're probably less likely to let it go to foreclosure. You're going to try harder to keep making those payments because that's a lot of money to lose. If you only have 5% into the house, or even 3.5% in the case of FHA, or heck, even 10%, you might be a little more likely to let it go if things got hard for you. So that's the idea of this 20 and why that's the magic number. Again, if you have less than a 20% down payment, then whatever your down payment is, in this case 5, the lender requires you to take out a mortgage policy for mortgage insurance to cover that amount of the difference. That's what mortgage insurance is. So it's a policy, it's an insurance policy. Who does it benefit? Who does this mortgage insurance benefit? Who is it there to protect? The lender. And therefore, who gets to pay for it? Since you're the one asking for the money, you, the buyer, get to pay for it. So that's just going to be extra. So let's say your principal, interest, taxes, and insurance payment is $1,600. You're putting less than 20% down. They're also going to tackle on PMI. Maybe another 100, maybe another $120, something like that. What happens though? Remember what we talked about? One of the advantages of real estate as an investment is that the value goes up over time. It just tends to, usually. Also, over time, you're paying your loan amount down. So your equity is increasing as you own it longer. Between your loan amount going down with every payment, between the value going up, and between the capital improvements, like you update the kitchen, you do the baths, all of those things mean that your equity is going to increase. Let's say you started at the 5% down. Over time, your equity is going to creep up. What happens if you get your equity all the way up to like 20% of the full value of the property? Is this PMI, private mortgage insurance, is that needed anymore? No. And the lender doesn't care. The lender's like, okay, yeah, we can drop it. In fact, once your equity hits 22%, they have to drop it. But even when it hits 20, if you want to petition the lender and say, hey, could we go ahead and get rid of that PMI? I think we're at 20. They would probably say, yeah, you're going to need to prove it. Pay for an appraisal, probably $500. And let's just see about that. And if you're right, then sure, we'll drop that extra $120. I pulled that number from AIR. It's like about somewhere around 100, 150, who knows? Depends on the loan type, loan amount. But yeah, they'll be willing to drop it if you can prove that your equity has reached or exceeds 20%. Does that make sense? So when it's a conventional loan, this mortgage insurance that we're talking about is called private mortgage insurance, PMI. That's for conventional. Well, guess what? When it's an let's talk about it real quick. Make sure I hit the highlights about PMI. There it is. So it's additional security for the lender if you, the borrower, default. It covers that extra difference between the 20% down that they wish you put in and the amount you actually put in. The buyer pays for it. You do need to remember that for the next chapter. It's based on whichever's lower, the sale price or the appraised value. The loan to value ratio that you're borrowing is based on the lower of sale price or appraised value. It's for loans where the borrower puts less than 20% down, and they are therefore insured by this private mortgage insurance policy. And for a conventional loan, it's called PMI, private mortgage insurance, and it's temporary. How long does PMI stay on the house for? How long do you have to pay this additional chunk for PMI? Well done. Hanging in there. Good job. It's as long as it takes you to hit that 20% mark of equity in the property. So it's removed when that 80% LTV is met. 80%, I thought you said 20. Well, 80% would be for the loan amount. 20% would be your equity, right? They are reciprocal. One added to the other equals the full amount of the value. So that's PMI. Anytime you see PMI, you're going to think to yourself, oh, we're talking about a conventional mortgage. Because when it's an FHA loan, it's not called PMI. It's called MIP. But it stands for Mortgage Insurance Premium. So it's basically the same idea. Now we're going to talk about the FHA loan. FHA loans, first and foremost, they love to test you on this word. They are insured, not guaranteed by the federal government, by the Federal Housing Administration. FHA does not originate loans. You don't have to go through the government FHA agency to get the loan. You still go through a normal bank or lender, wherever you would get a conventional loan. But the FHA insures them. You still do the same process you would for conventional. You still go to the same lender to make the loan. The lender still sets the rate. If you don't like the rate this lender offers, go down the street. Maybe that lender will give you a better one. The lender is still the one you have to satisfy to get approved. And then the buyer pays for the mortgage insurance, but it's called MIP, Mortgage Insurance Premium, when it's FHA. Why is an FHA loan a benefit? What is a positive for it? Well, it allows for lower down payment, as low as 3.5% down payment. Typically, conventional is minimum 5% down. FHA lets you get down to a 3.5% down payment. It allows for lower credit score. It allows a higher debt to income ratio. That back end ratio, instead of 36%, could be as much as 43%. It also is not allowed to include a prepayment penalty, right? We covered this before. Here's the big negative. If you have a choice between an FHA and a conventional mortgage, this one thing would be a great reason to pick the conventional one. Even though you're going to have to put a higher down payment to get the conventional one, at least on a conventional mortgage, you could eventually get rid of your mortgage insurance, your PMI. But when it's FHA, that mortgage insurance never goes away. the MIP sticks to it forever, the entire duration. So what is it worth to you? Is it worth the fact that you can only put 3.5% down? Maybe. That's a valid reason. I just don't have it, or I have it, but I don't want to spend it. I want to keep some of my money in reserve. So I want to put as little down as I can, and that means FHA for 3.5%. Yes, I can never take off the MIP. The mortgage insurance can never fall off. By the way, if you have an FHA loan where they're charging you mortgage insurance, MIP, forever, what's a way that you could get out from under that mortgage insurance on that FHA loan? Perfect. See, Joseph gets it. Get rid of it by refinancing. So that could be the game plan for your client. You as the broker could say, look, client, talk to the lender about this, but it might be good to do whatever you got to do to get into the house, because later you could refinance and it'd probably be around the same time that you would have hit the 20% equity mark anyway. Maybe around that same time in 5 years or so, you go ahead and refinance into a conventional loan, and now you don't have that mortgage insurance anymore. The house has appreciated, you've paid the loan down, you've done some improvements, the value's higher, you got some equity built up. You can refinance, take out some equity, apply it to the new loan, and go in that new loan right off the bat with more than 20% equity and get rid of your mortgage insurance. They wouldn't even charge you for it, right? Because you come in hot with the 20+% right off the bat. So that's the benefit and the one big negative of an FHA loan. Let's talk about the other government-related one. And here's the big difference. Again, the word guaranteed. VA loans are guaranteed by the government in the form of the Veterans Administration, Department of Veterans Affairs. Again, VA is not who you go to get the loan. They're just guaranteeing the loan, but you still go through the same process, go to the same kinds of banks, mortgage companies, lenders, make the loans, set the rates, do the approval. There's one little nuance that a VA loan, even though they don't typically make loans, if that veteran or military person wants to buy in more of a country area, like a more rural area, maybe a lender says, that's way too out in the sticks for us to make a loan out there. We're not going to cover it out there. The VA will step in and say, well, we'll do it. If our veteran wants to buy out here in the sticks, we'll let them. We will make a direct loan in a rural area for them in that occasion. Even if a lender won't, we'll step in. That's the one time where the VA will actually make a direct loan to somebody. If no lender is willing to do it, they'll do it. So what are the benefits of a VA loan? The lowest possible down payment of $0, right? They are also allowed to prepay without a penalty. Both FHA and VA loans are not allowed to have prepayment penalties. And you can assume a VA loan. So if you're a veteran and you bought your home with a VA loan, you could, when you go to sell your home, tell a potential buyer, look, I'll let you assume my existing VA loan. And even though they're not a military person, they could still assume it. But here's the deal. The VA would have to approve them. They can't, it'd have to be what's called a qualifying assumable. There used to be, before mid-80s, there were a pile of loans that were what's called non-qualifying assumable. You wouldn't have to qualify. You could just come in and assume someone's loan. That's a pretty sweet deal. But they've done away with those. I doubt there's many left from the 80s. And so now, if it is an assumable loan where somebody can come in and buy the house and just take over your mortgage, they have to get approved for that. And so, yes, VA loans can be assumed by non-vets, by non-military, as long as the VA approves them. Just the credit worthiness, really, is the only thing they care about. Are they going to default? Are they going to pay their mortgages? But here's the thing. When you're a vet or military, you have a certain amount that you qualify for under this VA loan. And if you have let someone else assume your VA loan, you can't use that qualification amount to yourself anymore until they refinance and let it go. While they still have your VA loan tied up that they have assumed, that money is no longer available to you. So if you need to buy your next house with VA money, probably not good that you let someone assume your VA loan because they're using up your eligibility, your amount of eligibility. I don't know how many loans are assumed in this way. I can't imagine it's a lot. I feel like people probably just straight up sell them because they want to use their eligibility on the next one too. Some negatives for VA loan borrower is you've got to pay some funding fees at closing. There's no down payment, but you have to pay some funding fees and an origination fee. And you can do unlimited VA loans in your lifetime, one after the other, but only one at a time. One VA loan at a time. Good point. There's a voice of experience there. Yvonne says funding fee is voided if the veteran has a more than 10% disability. Good to know. There's, let me think. It's called Military Relocation Professional. It's the name of the designation. There's many designations you could get. If you ever, as you're going to be looking around at different real estate agents and interacting with them, you'll see they have letters behind their name. Some of them are GRI, CRS, ABR, SRES, and one of them is all about the military. So that'd probably be a good one for some of you who kind of have that as a side thing or as an expertise or a history to kind of, you might want to make that your niche, is to work with other VAs, other military. Depends on where you are as well. If you're near a base, definitely. Charlotte, we probably have some pass-throughs. We don't have like a major base except for, I guess, Fayetteville would be the closest one, I think, right? But good to know, right? Good to have that expertise so you can say, look, I'm very well versed in this particular type of situation. And they'll gravitate towards you because they like people to know, like to work with people who know what they're dealing with. And that's a lot of intricacy in these VA loans. A couple other things about it. An appraisal is called a certificate of reasonable value when it's a VA loan, a CRV. That and the appraiser who does the appraisal has to be certified to do VA appraisals. Same for FHA. You can't just be a regular appraiser and then just go start doing FHA or VA appraisals unless you get the certification, because you need to know what to look for. Keep in mind, what is the purpose of the existence of FHA loans and VA loans? Helping people who otherwise couldn't get a loan. So let's make sure they're set up for success, not failure. So a couple of the things about an FHA or VA appraisal are these. The roof has to be good. You can't get FHA loan money on something that's got a 28-year-old roof, because most shingles are only good for 25 to 30 years. And so if that borrower who just barely scraped by to get into this house with this FHA loan next year has to buy a $15,000 roof, that's probably going to blow them out of the water. So if an FHA appraiser is going to write up an old roof in a second, they're going to say, look, you cannot buy this house unless a new roof is put on it. And then that borrower would say, well, I don't have money for a new roof. Will the seller do it? And the seller will say, do you know what kind of market we're in? No, I'm not going to put on a new roof. You may walk away and I'll keep your due diligence money, and you never should have come here to begin with. So as brokers helping people buy, it's important to know what kind of financing they need, because why would we ever show them a house if they're going to use FHA financing or VA financing that wouldn't pass the appraisal, right? Know what the appraiser's looking for so that you don't get them connected and emotionally invested and certainly due diligence money on the line for something that's never going to work out. Other things, the roof needs to be in good shape. No broken windows, no major holes in the wall. I've fixed windows as a broker and repaired holes in the wall so my VA buyer could actually get the loan. And it wasn't my listing, but I knew my VA buyer wouldn't get the appraisal would never go through. It needed to be fixed, and it was a bank-owned property, so the bank wasn't willing to do the work. You got to do what you got to do, right? Sometimes. They gave me permission to go there and do that, by the way. But whatever it takes, right? It was a couple $100, some sheetrock, some panes of glass got cut from Home Depot. My borrower went in there and put in the glass, replaced the glass, while me and my little brother replaced the parts of sheetrock that somebody had kicked or punched. And another big one about FHA is it has to have a working range. If it doesn't have a range or one that works, you're not getting funded for an FHA loan. So that appraisal is important. And that's why I mentioned a little while ago the difference between an appraisal and an inspection. The appraisal is indeed about the value. But when it comes to FHA and VA loans, they are also looking at those specific situations. So they know that this borrower next couple of years is not going to have to spend more money. That could mess them up and cause them to default on the loan. The veteran has a certain entitlement amount available to them, and that's going to be based on how long they served and how they were discharged. And then their certificate of eligibility is the maximum they're guaranteed to be able to borrow. Certificate of eligibility. So VA loans might take a little longer. They might need to talk to the VA early in the process to find out what some of these numbers are for them so that you'll know what price range to show them for houses. Just like, as well as talking to the lender. They need to talk to the VA so they can see what their eligibility is. Okay, we talked about conventional, FHA and VA. One big benefit of a VA loan is 100% loan amount or zero down payment. You don't have to have a down payment. What if there was another kind of zero down payment? Well, there is. A USDA loan is another government loan. And this one is guaranteed by the USDA. It's for lower to moderate income families or borrowers. So you can't make more than a certain amount in order to qualify for a USDA loan. It's also for non-city limits areas, more rural areas, USDA. And typically the outskirts, you could look at a map. You could just plug into Google search USDA loan map for Cabarrus County, for Mecklenburg, for Wake County, and it'll show you which parts of the county the property must be located in to qualify under this program. It is also funded in a certain amount, and so they might run out of money in a given year. So depending on the time of year your borrower needs this type of loan, it may not be available because it's already been used up. All that funding may have been used up. So it's not consistent. It's not just perpetual forever. Depends on if it's still available in a given year. The USDA subsidizes the interest rate and it allows for a zero down payment. But again, low to moderate income limits. There's some other kind of loans out there. Purchase money. If you see the word purchase money mortgage, that basically means seller financing. We've seen seller financing before, I think, when we saw an installment land contract. So that's another one. Installment land contract is seller financing. A purchase money mortgage is another kind of seller financing. A bridge loan. Anybody know what a bridge loan means? What are we bridging? Bridge loan is when you have a house you need to sell, but you want to go ahead and buy another one. They let you bridge the gap between the one you haven't sold yet and going ahead and buying the one that you want to buy because of time constraints, right? You don't want to let that risk losing that other one. So it lets you bridge that amount of time. A buy down is something where it goes back to the discount points. We can buy down the interest rate. Maybe you can't afford the current market rate. So by paying some discount points, you can have like a 3-2-1 buy down or a 2-1 buy down where the first year your rate's going to be 5%. Second year, it's going to be 6, and the third and beyond, it's going to be 7, something like that. So that'd be a buy down. A reverse mortgage, and this is all level 1, by the way. So just know what these things are. Nothing too deep. A reverse mortgage is what they sell you around 10 a.m. while you're watching The Price is Right, because that's when retirees are watching TV. So rest in peace, Alec Trebek, I think, was one of the sales spokespersons for reverse mortgages. The idea is this: you have a paid for property. You have 100% equity in this property, right? You've owned it for a long time and you don't have a mortgage on it, but you're in a retirement age maybe, and you don't have enough income from your pension, from your retirement accounts. So it's a way for you to spend your equity a little bit at a time. Now the mortgage company is sending you a check instead of you sending them a check. But when they send you a check, it's coming off of your equity. So you start with 100% equity in the house, and that just keeps going down and going down and going down. And yes, there's going to be a time constraint. So it's sad to think about, but the question when it comes to reverse mortgages is, how much longer will I need this money? In other words, will I be alive? Do I have enough equity in the property to last while I need it? Will I die first, or will I run out of it? So it's kind of that idea. A reverse mortgage is just paying you money from your equity over time, every month. A package loan is something that you would get if you were, for instance, buying like a model home that also had personal property in it. And you want to get a loan for not just real estate property, but also personal property. A blanket loan is something a developer would get for the entire 100-house complex or subdivision. And as they sell each one by one, off to the individual buyers, the loan decreases by that much. A construction loan is when you're building from scratch. And it's a higher interest short-term loan, and you would get approved based on the predicted future value that it's going to be worth once it's completed. But that lender wants to make sure that it's going to be worth that, and they also are going to give you what are called draws along the way. So you would get the first draw so that you could pay, or it would be the general contractor who would be dealing with this, but you would get approved for this construction loan, and they'd get a draw for a few $1,000 to do the foundation. And once that's done, the lender's going to send out a person to make sure it's done right. Did they really spend the money? And did they do the foundation properly? Next stage is maybe the flooring system. They're going to submit a chunk of money to go toward that and pay for that. And then they send someone out to make sure that got done. The walls, the roof, the plumbing, the electrical, the insulation, the sheetrock along the way. And then as you pull more money out to pay for these various things, you're paying interest payments on that money that has been given, that has been used to pay these various vendors. Once the house is completed, that construction loan is converted over to a standard typical mortgage, maybe like a 30-year mortgage. So it's converted over. And then finally, something you run into quite often is a home equity line of credit. You might have seen the abbreviation HELOC, H-E-L-O-C. It's sort of like the reverse mortgage, except you're not getting this money regularly every month. You're swiping a card. You get a debit card, and it's tied to your equity in your house. So as you swipe the card, it comes off of your equity. And so let's just say you still have a mortgage on the house, but you've owned it for a while, and your mortgage is, let's say, $100,000 that you still owe, but the house is worth $400,000. So your equity is $300,000. They're not going to let you have a home equity line of credit for that entire $3. It'll probably be more like 80% of it. They want to keep a little bit of a cushion, but that's still a lot. And so you could have this amount of money available to you at probably a decently lower interest rate than you'd get on a credit card, for instance, or even a car loan. So it might not be a bad way to maybe buy a car or make other investments, short-term investments. People do all kinds of things with home equity lines of credit. They probably shouldn't get too crazy with it. They shouldn't maybe go on a bunch of vacations unless they have the means to pay it back, because it literally comes out of your equity. Oh, let's see. Is that a question just in general, Joseph? When the owner dies, how's the lender get their money back? Yeah. So first of all, if an owner dies, the estate and the heirs are going to have to deal with it, right? So number one, what if in the reverse mortgage? Yes, ultimately it could carry that kind of a final end game. It could turn into the lender gets the property so that they can sell it. But in general, in the non-reverse mortgage, someone were to inherit property, then those heirs are going to have to decide, do we want this property? If we do, we're going to have to refinance or somehow buy it. We don't just get it and get to start making those payments ourselves. Or we could just sell it, which I think is what most people would probably do. Otherwise, if those aren't two viable options, the lender would foreclose on it. But with the reverse mortgage, yeah, the house could eventually go away. They're pretty tricky. And when you're a broker out there running into it, you want to find out, how long has this reverse mortgage been in place? What's the value? Where's the balance? Where are we at on this? You wouldn't want to do a bunch of work only to find out that the house is no longer owned by this person, right? It could get messy. And it also could be predatory. It could really prey on somebody's fear of having some stability. Sometimes when there's more than one loan on the property, a lower priority loan or lien gets moved ahead of a higher priority one, usually because of the amount of the loan. They're typically put in line based on when they were recorded. The first mortgage is first in line in case there's some sort of default. They get paid first. Second mortgage, second, etc. So that mortgage priority, the word subordination means a loan being subordinate to another loan. How do loans get approved? Well, there's that underwriting process. They look at a couple of things. They're looking at the borrower themselves. They're checking their credit score and their credit history. They're checking the income of the borrower. What are their expenses? What's coming in? What's going out? What are recurring obligations? And they look at the property itself, because they're putting the property up as collateral. Therefore, let's make sure it's worth it. What is it really worth? And let's make sure the title is nice and clear. So they're going to do a title search as part of that process too. And that's where all of these various things we've been talking about come together. So when you apply for a loan, there's always the question, what's the interest rate? And so if you go under contract today, April 6th, and we're going to try to close maybe in 30 days, somewhere around the end of the month, you're probably going to want to make sure that the rate you're quoted today is the rate you're going to get in a month when you have closing. More importantly, if it's going to be a closing further out than that, 60 days, 90 days, who knows what the rates are going to be? Are they going to be higher? Are they going to be lower? At some point, you can do what's called a rate lock. You can pay money to be guaranteed that the rate that you end up with is going to be the one that you have today. The rate today, they'll lock in for that amount of time. And it gets tricky if you get to maybe the day before closing and maybe for some reason the closing gets delayed. So one of the questions to ask if the parties can't close on time is, when does the rate lock expire? If it expires tomorrow and we're not closing tomorrow, then how do we extend the rate lock? Well, it's going to cost money. Who's going to pay for that extension of the rate lock so that the buyer gets that lower rate? Because now the rates are higher. Another set of negotiating. It depends on who's the cause of the delay. They might need to pay for the rate lock. Maybe you do. If they refuse, if your client refuses and you're like, Well, I don't want my buyer to miss out on closing on this thing because I don't want to miss out on getting commission for this thing. How much is the rate lock? $100, couple $100. I would do it upside down and backwards all day long if it kept everything on track and got us closed. But I wouldn't give it up too soon. I'd say, look, buyer, or let's say sellers, the reason for the delay, I need you to pay this rate lock. I would wait for everybody else to say no first. So since interest rates fluctuate, it's just holding that rate at a certain level. And it involves a fee and maybe a renewal fee or an extension fee. As brokers, you're working with a buyer. You're going to throw them in your car, show them a bunch of property, find one that they really like, and then find out, oh, this one is for $450. Oops, sorry, I only qualify for $380. That is something you'll do only once. After that time, when this buyer is now disappointed that they can't afford what they see at the $450 range, nothing is ever going to be pretty anymore. Everything they see at $380 is not going to be what they were seeing when it was $450 because it was never $450 that they could afford. Here's how you avoid it. Don't show them houses that aren't in their ability. Get them pre-approved. There's two different words, a pre-qualification versus a pre-approval. Which one's better? The pre-approval means that the lender has actually looked at some numbers. A pre-qualification is just a phone call with the lender, and the lender asks them some questions. How much do you make? How much do you spend every month? What's your credit card and your car payment? Okay, I'll believe you. Based on nothing more than their word, they should be fine to afford up to $425. And that's worth nothing. So pre-qualifications are garbage. You want a pre-approval because it means the lender has actually looked at their credit score, looked at their credit history, maybe even had them verify some pay stubs. Some lenders go really extensive with this. Some lenders will say when we do a pre-approval, we've looked at a whole bunch of stuff, and you can rest assured, Mr. Broker, Mrs. Broker, that you're going to not be wasting your time with this borrower. But that takes a little time. So if you want a quick answer, those kind of lenders aren't going to be able to give you one because they're going to insist on doing a little more of a deep dive to give you a pre-approval letter. So not all pre-approvals are made the same, but they're all better than a pre-qualification letter. So borrowers should find out what they can handle. And here's what I say to buyers. Look, buyer, when you talk to this lender, even a lender that I give you, and the ones that I recommend are not going to be hard salespeople. Lenders that just really try to win them over and grab their business at the expense of whether it's the best fit for them. It's going to be more of a consultative approach, which is sort of how I do my business. So even though they talk to somebody like that, lenders are trained to talk in terms of the most you qualify for. That's just in their nature, it's in the training, it's just what they're used to. How much can you afford? And I don't care what that number is. And I make sure that buyer knows, don't shop for the most you can afford, buyer. I'm not trying, yes, I'll make more commission if you buy a bigger house. I don't care. I want them to know that I'm more about the best fit for their lifestyle. Because it's not how much they can afford. That's like borderline making them house poor. It's how much fits into their chosen budget and lifestyle. They might could afford $800,000, but if they need to put 3 kids through private school and have enough for a couple of vacations a year and go out to eat 3 times a week, and they want to make sure they have enough for a college fund, maybe they should be buying $400,000, not $800,000. And I'm there for that. I'm glad to sell a $400,000. Because when they get ready to sell that $400,000, they're going to remember that I didn't try to upsell them, right? And it's just not good for them. And it applies just as much, if not more, for the lower price points, even more price-sensitive people. You don't want them buying the most they can afford because it sets them up for failure. And so you want to have that conversation with them. Look, guys, when we get a pre-approval letter for that maximum you can afford, we're not going to tell anybody. We're going to consider what you want to fit into your life, and we're going to back down from that number. The most you can afford is 400. Maybe we need to be shopping at the 300 range. In the last few years, when somebody approved for 400, you couldn't show them a $400,000 house. Why not? Why would it do you no good to show somebody a $400,000 house if they could qualify, if they could get approved for 400? Yes, you got it. Because there's no way they're going to buy it for 400. You had to shop for enough lower to allow for all these over asking price offers, plus all this due diligence money, plus the work that it probably needs because sellers weren't doing repairs because they didn't have to. So you have to adapt to the market and train and educate your buyers accordingly. So another important point on this slide is a trigger date. The loan application date is the date when the lender gets the address of the property they want to buy. Why does the loan application date matter? Because the lender has to provide the loan estimate document within 3 days of the loan application. When you apply for your loan and give the lender the address you're trying to buy, that triggers the requirement that the lender shows you that transparent document called the loan estimate, where all the fees and charges are going to be located, so that you can't be surprised. You won't be surprised at closing. And then just like any credit that ever is issued, whether it's cars or credit cards or anything, if you are not approved for it, they have to tell you in writing that you weren't approved, so that loan denial will be given in writing. But that's just credit law. We'll talk about that loan application more when we come back, and I'll see you in 10 minutes. Hey, welcome back. Let's make our way back together. We finish up this last 45 minutes or so. We talked about loan application, and it's all about that loan estimate disclosure that the lender has to provide. It's required. And when is that loan estimate required to be disclosed and given to that borrower? What's the deadline for that? Within 3 days of what? Oh, I see this on practice exams. Within 3 days of this loan application date, the date at which the lender receives the property address. You got it. Okay, let's talk about some, let me see here. First of all, let me give you a little heads up. That loan estimate I mentioned to you. Can you see this okay if I zoom in? Seeing that pretty decent? What I've done is laid out these two things side by side. So here's what that loan estimate looks like. That document looks like this. Every one of them from every lender has to look like this. You've got the info here at the top, the people involved, the borrower, the sale price, the property address. You've got the term of the loan also on the top on the right. The type, is it conventional, FHA, VA, this stuff here. Is there a rate lock? And in this case, yes, and it's locked all the way through April. This is a few years old. And then the first section are the terms of the loan. They talk about the loan amount, in this case, $162. They talk about the interest rate at 3.875. They then show that the monthly payment of principal and interest, P&I, is going to be $761. And then you guessed it, is there a prepayment penalty? And in fact, there is. It says, yes, there is, as high as $3,240 if you pay the loan off during the first 2 years. And when there is a prepayment penalty, that's usually how it works. The longer you keep the loan, the less of a penalty. It might drop off after a certain number of years. And then another question, is there a balloon payment? In this case, no. If you recall, a balloon payment is what would happen if you had a partial amortized loan, partial amortization, meaning your first payments, let's say it's a 30-year loan, that's 360 payments, all the way up, but not including that last 360th payment is going to be at the same principal and interest payment. But this very last one is going to be bigger because what they did is amortize the loan for as if it were a 30-year term, even though it's going to end at, let's say, the 25. And so whatever the extra that hasn't yet been paid because you were paying lower payments than you normally would on a 25-year loan because they let you amortize it as if it were 30, whatever you still owe, you have to make up in that very last payment. So the last payment is higher. That's called a balloon payment. And in this case, there is not one. Then what we have are some escrow items mentioned down here. So they spell out what the loan is consisting of. They say that the principal and interest part of the loan is going to be $761. They're going to charge mortgage insurance of another $82, and the estimated amount for taxes and insurance is another $206. So their total payment, including all of these things in this case, is $1,050. From this $206, they bring it down to here, and they talk about that is called taxes and insurance. Check the box if it applies, and it's both of those things. So just full disclosure, right? They're just making sure that the borrower has complete knowledge of what they're expected to pay. Notice this part too. The mortgage insurance of $82 is going to apply in this case from years 1 through 7. And then after that, it's dropped off. So the payment is going to go from $1,050 down to $968 because of the PMI. That's not like a hard rule. It's just whatever the situation is has to be disclosed. And so they did. And then finally on the first page, because this is a several page document, also they mention, look, hey, borrower, you're going to have to pay some closing costs to get this loan, and it's going to be $8,000. And then that plus whatever your down payment needs to be is going to mean that you're bringing to closing $16,054. So that's what the loan estimate looks like. And again, every lender has to show it in the same format. And that's what's required within 3 days of loan application. Now, let's fast forward. This was within 3 days of loan application. Let's go to 30, 40 days from now when we have a closing. Within 3 days before closing, the lender has to provide a closing disclosure, which looks like this. Oh, wait a minute. That looks exactly the same, except for the title, the people and the property, the type of loan, the loan amount, the interest rate, the P&I, prepayment penalty, balloon payment, the breakdown of the principal and interest, the mortgage insurance. These are the numbers that actually ended up being the truth. The loan estimate was just their best guess. It needed to be pretty darn close though. But the closing disclosure is showing, look how good we are. We estimated that so close. Look, they were off about 35 cents on the mortgage insurance. I'll take it. They also reflected here. Originally, all they did was allow for taxes and insurance, but it turns out the borrower ended up having a homeowner association dues as well. So they had to go up on that a little bit. And so what ended up really happening when they first did the loan estimate, it was going to be $16,000 needed to come to closing with, and they ended up having to come up with less because there are a couple of categories of fees involved. And we'll talk about those. We'll just talk about them now. Some of the fees, let's do it over here. There is a zero tolerance allowed, right? Those meaning they better be exactly what the lender promised back at the loan estimate. And then brought forward to the closing disclosure. Must not be any different. If it is more, then the lender has to absorb it. They have to pay for it. That's the category called zero tolerance. Zero tolerance for anything more than what the lender promised back at the loan estimate. The next category is a 10% max. Those are things that, by the way, the zero tolerance types of things would be origination fee, discount points, things that the lender has full control over charging. Then we've got the 10% max. That's stuff where the lender gives them a list of vendor choices to pick from. Because that lender said you either have to pick this one, or this one, then they have some responsibility for the cost of these. So that if those estimates end up being more than 10% than they promised, the lender has to absorb that. can't exceed more than 10% higher. And then finally, there's the no limits category. And that means lender has no responsibility for these at all. A good example of these are inspections. The buyer wants to buy or pay for an inspector that's more expensive, like $1,000 instead of $700. Well, that's on the buyer. That's their problem. That's not the lender's problem. The lender's not going to kick in. They're not held responsible to that sort of thing. So on the additional pages of these documents, they cover that stuff. And on the actual closing disclosure, meaning the settlement statement, which has all of the fees attached to it, we see those categories broken down. Let me show you. Here's that. Oops. There we go. Here's that closing disclosure that we're looking at. This is live on a website. Same one. I just screen captured it. And here's page 2. This is one of the pages of the entire breakdown. We don't have to dig into this. I just want you to see it as a reference. When you get to post licensing 302, we go into great depth. We analyze this thing. You actually have to make one from scratch and know where to put all of the dollars. But this is what the closing attorney is going to do. Well, actually the paralegal. This is page 1. And this entire page, forgive me as I give you motion sickness, this entire page is all expenses. Nothing on this page is going to be credits to anybody. So this is straight up expenses. There's another page I'll show you next. And look what they've got here. Box A, all of these are the zero tolerance items. The underwriting fee in this case, $1,097. That's better be the same at the closing as it was at the loan estimate. The application fee of $300, it looks like some points, 405 for points. Those, if they change, the lender has to pay for them. And this is where they live. This is where they are reported. This first column is all buyer stuff. This other column next to it is all the seller expenses. Not all of them, but everything on this page are expenses. There's some additional expenses that we'll get to on the next one. The next category is that 10% thing I told you about, where if it goes beyond over 10%, the lender has to absorb it. And that includes credit report fee, appraisal fee, flood determination, monitoring. You don't need to know about any of that stuff, but just know that whatever the lender promised on the loan estimate could not exceed more than 10% higher. Otherwise, the lender pays for that. And then they have it, box C is the no limit, where the borrower chose to hire that pest inspection and that surveyor and get that title insurance from that lender, that attorney. And all of these are whatever the buyer wants to pay for them. The lender has no responsibility for those. We add all these up, and that comes up with a total of that top half. Then we get into some additional fees that are not related to the loan, but they're related to the transaction, like homeowner's insurance for the first year, prepaid interest for the month of closing. Got to pay interest per day from the day of closing all the way through the end of the month. It's called interim interest. We'll talk more about that. The property taxes, they might show up here. Depends on what time of the year that they take place. In this case, there's some HOA fees. There's my favorite one, meaning not my favorite. HOA capital contribution. Congratulations. Welcome to the neighborhood. Pay us $500 basically to set up the HOA. And it looks like some little frilly kind of fluffy stuff. Processing fee of $150. There's a home inspection of $750. And then the full total of this entire page that the buyer has to pay for expenses is down here at the bottom, $96.82. And then they have the seller's total here, which includes commissions, a warranty that they're paying for the buyer, and some excise tax. These totals at the bottom of the page, flip over to the next one. And this is the big, I still think of this as the front page because the attorney usually puts it first. But these are in 4 boxes. Again, we're not deep diving here. I just want you to kind of see the landscape. It's got those amounts from that last page. Here's that total 9682 for the buyer, and then over here the seller's part. Down here, where'd it go? 12,800. And then at the bottom of this page is how much the buyer needs to bring, $14,000. And then how much the seller is going to get, $64,000. So that's kind of what this closing disclosure grows into. And then it's got some other stuff, just basic disclosures about the escrow and things that may not apply. And that's it. This last page is just identifying some people, the brokers, the lender, the closing attorney. So that's how those things are kind of related to each other and how we kind of see them. And it's all because of these legislations. So there's something called the Truth in Lending Act. Truth in Lending Act says, hey, lender, you better tell them everything that's associated for fees with this loan. RESPA stands for Real Estate Settlement Procedures Act. The settlement has to go according to a certain set of procedures. Pretty simple. It's designed to protect that consumer from the shady lenders and shady brokers. So mainly the lenders have to disclose these things very transparently. Within RESPA, there's a regulation called Regulation Z, which says that all the fees have to be disclosed associated with the loan. It also says that when you advertise, you have to tell the whole story. Whether you're a broker or a lender, what do you think would be a better ad that might get more responses? If I said 123 ABC Street available for $438,000, or if I said 123 ABC Street available for $1,250 a month. Which one might get a little more attention, right? The car dealers do it all the time. It's all about that monthly payment. They like to talk in monthly payment because they can hide more expense if they just break it down to month. We can do that too, but not quite to the same level. Certain loan-related items are called trigger terms. So while you can advertise a mortgage payment, that's called a trigger term, because by advertising that payment, it triggers the requirement to advertise how the payment is possible. If you advertise the payment, you also have to advertise and include in the fine print the interest rate, the finance charges, the total amount being financed, and the number of payments. So, any of these items are considered trigger terms. They trigger the need to disclose the others of this list. So here's the question. Are you allowed to advertise trigger terms? Yes. But if you advertise a trigger term, you have to include all of this other info too. You with me? So trigger terms are allowed, but they trigger the requirement to add to the fine print. You got to tell the whole story. Whether you're a broker or a lender, you have to identify and acknowledge all the credit terms associated with this payment. Either you provide all of it or you provide none of it. Either you can use it, in which case you use all of it, or you don't use it at all. So anytime it's a payment, you got to also talk about the APR, by the way, stands for annual percentage rate. Don't want to overlook that. Any finance charges, number of payments, amount financed, all of those are trigger terms. Some things are not. What if I were to say the seller will pay the buyer's closing cost up to $10,000? Is that a trigger term? Seller will pay your closing cost up to $10,000. Is it in this list? Is that related to a payment directly? No. Seller paying buyer closing cost is not a trigger term. seller paying for a credit report fee or a lender doing like a free credit report fee. Not a trigger term. You can advertise these individually by themselves, not requiring the other things to be disclosed. HOA dues covered, paid for by someone else. Not a trigger term. The only thing trigger term related, again, pretty much about the rate, the payment, the amount financed, and the number of payments. Those are trigger terms. You have to disclose all of these or none of these. What you can also advertise is generic terms that are not triggering the need to tell the whole story about interest rates and all that other stuff. So you can talk general, like 0 down payment, low down payment, no payments. That's generic enough to not require talking about the rate, the amount financed, on all that stuff. So that's some easy points there. Can you advertise trigger terms? Yes, but that means you have to advertise those other things that make that payment possible. There's something called the Fair Credit Reporting Act that the lender has to follow. It sets standards for credit reports. Anybody checked your credit report recently? You get a free one every year. Take a look. Stay on top of that stuff, because as many card offers as there are out there, inevitably there's some wrong information. There might be stuff that you really did that wasn't great, but there's almost certainly some wrong stuff on there that you could dispute too. So the time to fix it is before you need it, right? Don't wait until you need to get that car loan or that house loan. Stay on top of it every year and make sure that you're keeping everybody in check and nobody has put something on there that doesn't belong there. And if there is something that belongs there, handle that too. This gives you time to fix stuff and work out some sort of a plan to get it handled before you need to do something. Same thing for your clients, right? Sometimes you talk to people that are more than willing and ready to go, but not according to their credit. And you have to put them on a list and just be like, look, guys, we need to work on this and take this up in 6 months or a year from now. You might even align yourself with some credit repair facilities or services and kind of have something in place to help somebody and turn them into a future buyer because you helped them along the way. So this Fair Credit Reporting Act lets you see your report once a year for free, lets you correct errors. Most negative info is going to stay on it for 7 years. Bankruptcies and foreclosures are special. They stay longer, like 10 years. And I'm sure you've run into all that good stuff before. Most people have a feel for how that credit reporting process works. There are some protected classes that we as brokers cannot discriminate against, right? You should not limit someone's availability to buy or sell a house based on their membership in certain groups. And those are called federal fair housing classifications. We're going to get into that when we hit chapter 19. And those, by the way, are familial status, meaning are there any underage kids? So you couldn't advertise a house and say this is good for a single owner, single occupant, because you're not allowing for the kids. So you've discriminated against them in terms of familial status. You also can't discriminate, obviously, against race, religion, sex, which includes gender identity, sexual orientation, male, female, disability, color, and national origin. Well, obviously, right? Real estate, money is green. We don't care what anybody looks like, where they came from, what they believe in. Let's just make it available to everybody. When it comes to credit and lenders, there are some additional categories. And that's these three. Under the Equal Credit Opportunity Act, it says that a lender cannot discriminate against someone, not agree to give loans to someone based on their age. I have a friend whose grandmother died at 104 years old. When she was 103, while she was still healthy, she could have gone into the bank and said, I want to take out a 30-year mortgage. And it would have been illegal for them to deny her based on her age. That's what we're talking about. So they can't discriminate and deny a loan based on age, marital status. Oh, you're single? Then no loan for you. No, not allowed. And also public assistance income. Oh, you get some of your income from the government or some public assistance? Then no, we're not going to give you a loan. Also not allowed. These are 3 protected classes that the lender has to follow. They can't discriminate and deny a loan because of age, marital status, or public assistance income. And we're closing in on the end of this thing, guys. So just a suggestion to recover when you're studying. Look back through the material, the primary versus the secondary market. The people, the groups that are in the secondary market, Fannie Mae, Ginnie Mae, Freddie Mac, the loan types, conventional, FHA, VA, Federal Reserve and its role in helping to keep the economy stable and set interest rates and making loans to consumers, and the difference between conventional FHA and VA. FHA loans are insured by the government. VA are guaranteed by the government. Conventional are not guaranteed or insured by the government. They're private. Conventional loans are private. That's why the mortgage insurance is called private mortgage insurance when it's a conventional loan. And then RESPA, Regulation Z under RESPA, trigger terms, those 3 lender-protected classes of age, marital status, and public assistance. And that's it. We're done with finance. Let's talk about closing procedures. All right. Well, post-licensing 302 is my favorite of the post-licensing classes because it's about contracts and closings. That's where the money comes from. You're not getting paid unless those things happen. 301 is about agency. That's important because of course, our fiduciary relationship. 303 is a weird one. It's got a bunch of miscellaneous commercial property management and this and that. But closing the transaction is huge, right? It's all about closing. Here's our job description. Get them to closing. Don't be fancy. Don't say, well, I'm not going in there. I'm not going to do that. That's their job, not mine. Well, that's not my attitude. What does it take to get it closed? Okay, let's make that happen. That's what this is about. So there are certain procedures involved here. Some level 1, what is RESPA? We'll get more into it. Level 2, what are the pre-closing procedures? What are the closing procedures? What does the settlement statement look like? We've already gotten a glimpse of that. What are our responsibilities as brokers? And then some big math calculation stuff. This is where a lot of the 8 calculation questions are coming from. Related to prorations, prorating for taxes or for rent. If you're selling an investment property, how much rent do you get to keep versus have to give to that new buyer if you're closing midway through the month? And then calculating the various expenses, also known as debits and credits. Debits and credits. Once a contract is signed and we have an executory contract, don't believe what they show you on HGTV. Nobody's celebrating yet. We're not paid yet. We got a lot of work to do. We did a lot to get to this point. Now we're under contract. There's still a lot to do. And so part of that includes this. That closing is where we're transferring that deed, passing that deed from the seller to the buyer. Well, the deed needs to be written. It's going to be written based on the contract. The deed is going to be given to the buyer in exchange for the buyer giving the consideration to the seller, right? That purchase price. And the rest of the day, that meeting at closing is all about dispersing the money. There's a lot of funds involved in this closing. Well, first of all, the biggest one is that the seller is going to get their proceeds check. I think we saw that seller got $64,000 on that CD. What else got paid from that closing? The property taxes get paid or accounted for. A warranty company gets paid if there's somebody's buying a warranty for the buyer. An appraiser got paid. Inspector got paid. The brokers get paid. There's a lot of checks being written, and it's the closing attorney who's doing that. That's why they're making their money. They're not making a ton. They might make $1,000, $1,200 to do a closing for a buyer, and then another $400 or $500 of deed preparation for the seller. But they're writing a lot of checks from the results of this closing. And don't forget, our favorite way to terminate a contract and an agency agreement is to have the fulfillment of those terms, that successful closing. That's when we get paid. It's not when we earned it, it's when we got it in our hands. And so as a reminder, there's a big difference between settlement and closing. Hopefully they're on the same date, but maybe not. That settlement is about people signing things, executing documents to transfer the property, delivering those documents to the attorney. The closing is about recording the deed, therefore it's about the paper. Buyer gets possession, the seller gets their proceeds, the brokers get their income, their commission. And then officially, best practice is for the keys to go to the buyer once the deed is recorded. But that's not like a rule. It's not a law. If it's a seller who's okay with it, a builder maybe, they might be okay with it. They'll say, look, I'm pretty confident it's going to close. The deed's going to be recorded. There's no additional liens that are going to pop up, and within the next couple of hours, it'll record successfully. So, okay, go ahead and take the keys. Go ahead and start moving in. But as a broker, we want to make sure they understand, look, you don't have to do that, seller. You don't have to give them the keys until we close. Have that conversation with them before you get into the same room with the buyer staring at you. Oh, she's a real jerk. She's not letting her client give me the keys yet. Let's figure that out early so that you can say to them, look, guys, as is pretty standard, once the seller gets their check, once the deed gets recorded, the seller gets their check and you can get the keys. And tell them that ahead of time, especially as the buyer agent. Make sure your buyer's not expecting to walk out of those doors after they just signed and the ink's still wet. Get the keys and get into their U-Haul and get over to the house, start moving stuff in. That may not happen. Might be a couple hours. Probably will be at least a couple hours before they finally can actually have the deed recorded and therefore have possession. What are we doing during that due diligence process? We've talked about it a bunch by now. Deciding if they want to actually do this thing. They're already subject to losing that due diligence money. Now they're deciding, look, based on new information, what the inspector says, all the various inspectors, the appraiser, did it appraise for the full value? The surveyor, is it in a floodplain? Is there an encroachment? All kinds of stuff. Depending on all that stuff, do I, the buyer, want to actually go through with it? It's up to the buyer to decide to terminate or proceed. And they have that amount of time within the due diligence period to do so. It's all about that earnest money coming back to them or not. And they're doing all these things. It's up to that buyer to decide the closing attorney, by the way. Sometimes if it's a builder, the builder will give the buyer an incentive to use their chosen attorney because it's just going to be easier because they already know what's up and what the property's all about. But oftentimes the closing attorney will say, hey, buyer, I'll give you X dollars toward your closing costs if you use the attorney that I prefer. So that kind of thing might happen. But usually, especially on a resale, the buyer picks the attorney because the attorney is doing most of their work for the buyer and the lender. Buyer chooses the lender and inspectors and surveyor. All of these are many times recommended by you. They're looking to you for a good referral to people that will take good care of them in these areas. So they're kind of leaning on you for this stuff. And you're going to want to probably make a couple of recommendations. This one or that one. This inspector, that inspector, maybe three for each. And they pick They shop and they pick which one. And all of that you'll develop over time. You'll get relationships. You'll learn, oh, this attorney is willing. They're a little more flexible. If we have a delayed closing, they'll make it happen that day. I had this other attorney one time that was very inflexible. They weren't willing to stay late. They weren't willing to get it done. You'll kind of learn those along the way and make your choices accordingly in terms of who you recommend. By the way, when you recommend these various vendors, you can't get paid for it. That'd be a kickback, and RESPA won't allow it. The Real Estate Settlement Procedures Act says no kickbacks. You better be referring them to a lender or to an inspector because they're going to do a good job for them, for your client, not because they're going to slip you $100 under the table. We know that there's no loan contingency in the offer to purchase and contract. So therefore, if the buyer can't get financing, we need to figure that out as close as we can within the due diligence period so that they have a chance to walk and recover at least their earnest money, since they won't be getting their due diligence money back. And what sorts of things is the buyer looking to accomplish? What are they worried about? What do they need to verify? You as their broker need to make sure they realize that all of these things are important. They're looking to you for this stuff. You're not just one and done. You didn't just sell them a cell phone and they walked out the door and now it's on them. You need to be a resource in a network, a resource to a network of all these various vendors. Help them figure out that the property's right, even the insurance, right? The insurance might be extra high because that particular house seems to have recurring problems, a lot of claims against it over the years. Streets and roads. What do I mean by streets and roads? How is that a concern to the buyer? How do streets matter? Yeah, who's maintaining them? You got it. Is it a publicly maintained street or privately maintained? Septic system. What is that septic system perk for? Does it perk for a 3-bedroom or a 4-bedroom home? Wood destroying insects. Do we check for those, or is all that looking good? Is the zoning right? Does the zoning need to change in order for them to want to go through with this? What sorts of covenants and conditions? If the property didn't appraise, what are the choices if it doesn't appraise? Do we talk about that? Here's what that looks like. If the purchase price is $300,000 and it only appraises for $280,000, who cares about that $280,000 appraisal? Buyer for sure, but who also? There you go. That lender says, oh, you want me to give you a 90% loan to value ratio? Well, you were planning on buying it for $300,000, in which case that 90% would have been $270,000 that I would loan you. However, it only appraises for $280,000. So guess what? I'm only going to loan you $252,000. Well, another part of the problem with that is, what do we do now? The seller says, look, you promised me $300,000. And now the buyer's like, well, the lender will only let me borrow 90% of this lower amount. And I've got some professional appraiser telling me it's not worth $300,000. I don't want to pay $300,000 for something that's not worth it. And the seller's like, well, tough. Welcome to a seller's market. If you don't buy it, then walk away, please, and let me keep your due diligence fee, which they would, and I'll just throw it back on the market, and maybe the next buyer appraisal will come in closer to the $300,000. So what if the parties here want to hold this together, make this work? One choice would be what sounds like the seller's not willing to do, and that would be reduce the sale price down to the appraised value. So that's one choice, but this seller's not doing it. The other choice is the buyer could say, well, let me see if I can scrounge up another $20,000, add that to my down payment so that I'm still getting the loan based on the 280 and I'm able to give the seller the full 300 that they want. They're going to get the loan amount of the 280 from the lender, and then I'll give them another 20 to make it up, the difference. If the buyer can afford it. They may not have the ability to do so, but that's another option. That's the second choice. Or the seller could say, well, I won't come all the way down to 280, but I will come down to 290. If you, the buyer, can come up and add $10,000 to your down payment and meet me right there in the middle at 290, or anywhere in between, right? Somebody coming down, somebody coming up to meet somewhere in between. And then, of course, what could happen is the seller says no. The buyer says, I'm out of here, and the buyer's losing their due diligence money. Because even if it doesn't appraise, they don't get that back if they decide to walk away. And that could get really sensitive, because what if that buyer is getting an FHA loan? And what if they already have just barely enough to put the 3.5% down? They scraped up like $9,000 for due diligence money. Now they're losing that. Are they going to be able to jump right back out in the market and go find another house? Maybe not. Maybe not until they save up another amount of money to be due diligence for the next one. So that appraisal coming in low can really throw a wrench in the works. And you guide them through that. You and your BIC until you get really good, and then you do it by yourself. They're leaning on us for all this stuff, guys. It's so much more than finding the buyer. That is such a small part of this. They know what's out there. They have 1 million websites. They come to us and say, I want to see these 11 properties. I always kind of laugh to myself when they give me a list of 11 or 20, because I can predict with 99% certainty. They give me a list of 20, I'll bet 17 of them will be under contract and unavailable. Because who knows how old those listings are. It's just something that happens, and you're like, okay, let me look these up and see which ones they can't have. And then I say, well, sorry guys, there's only one left out of this list, but I'm going to keep a current list. I'm going to keep doing a search fresh all the time. And as soon as anything matching the criteria pops up, automatically I'm going to send you an email. And you can set that up usually in your MLS to happen automatically without you having to do it. You get notified. You can take a look if you want. I don't really look until they tell me something they want to go see. But all of that is on you too. But that's still such a small part. Now you found it and got under contract, and now you have all this to do. That's why teams can be a good solution if you're willing to take the lower split, lower commission income, because you don't really have to do much of this. If you're a buyer agent on the team, they give you a buyer lead. You go find that house for that buyer, get them under contract, and hand the file over to somebody who does this part for you. A closing coordinator or a transaction coordinator. And it's their job to handle all of this stuff. And most teams that do it right will keep you involved to check in, maybe call the person from time to time to make them feel like you're on top of it, but you're really not doing any of it. But you're their contact person, right? And you just get the next buyer lead and go back out there and find another house, get them matched up, pass it back off to the closing coordinator, and keep on going. And you do a very small subset of the business compared to what you would do if you were a general broker of your own. And you're doing all of these things. What else? Fuel tanks, being aware based on the size, the age of the house, and how things look inside, and maybe the history and maybe some pipes poking up out of the ground or some rainbow looking puddles from the rain, maybe there's a buried oil tank somewhere. That's a big deal. So you need to be looking for red flags of flood zones and oil tanks that are buried and flooded basements and all that fun stuff too. Testable item about the wood destroying insect report, and then we'll call it. What does that? It's called a WDIR, wood destroying insect report, and it's more than just termites. We call it a termite letter, but there's other insects that eat wood and cause structural damage. Carpenter bees, powder post beetles, they can all eat wood and cause issues, but termites are the big one. But that WDIR is not saying, I promise there's no termites. It's just saying, from what I could see, this is the inspector who's saying this, from what I could see without moving anything around, I didn't see any termite damage or termites. Or I did, and here's where they were. In other words, they have a limitation of their scope. It says on the report, look, I'm not going to take the kitchen cabinets off the wall. I'm not going to unscrew them and pull them off the wall and look behind the cabinets. There could be termite damage back there for all I know. But I'm not going in there to look because I'm not required to. Even the garage, that's a big one. What do most sellers have in common? Well, first of all, a lot of people live in their garage like a storage unit or like a recreational area. It's like another living room, and they've got all this stuff stacked against the walls. That inspector isn't supposed to pull things away from the wall. They want to look down around the baseboard where the floor meets the wall and see if any termite tunnels, little mud tunnels, are coming up through that crack. And they're not able to do that. They're not allowed to do that. It's a liability issue. And so it's as good as it gets. I mean, you could try to say, look, make sure your seller pulls things away from the wall, because what that inspector's looking for are these kinds of things, these little mud tunnels in the crawl space, in the garage, but they're not able to pull objects away to look really deeply. So all that termite report says is, I can't see any, but they might be there. There's no guarantee. It just reports that on this day, at this time, what I saw was clear. Or if it's not clear, they have to say so. Then you go about getting estimates and quotes for the repairs that are needed. And you're talking about a quote to get it sprayed for termites, treated. That might be like $1,000 usually for a whole house treatment. And then another maybe quote for the actual repairs that are needed to make it structurally sound again. Because maybe those little critters ate a bunch of support beams, maybe some floor joists, maybe some band sill that the house rests on. The first layer of wood between the house and the foundation, the brick foundation. So it could be a big deal. We'll keep on going, including the math. So read ahead between now and next time. Let's see here. There we are. There we go. So here's our order. We're doing closing the transaction. Then we're doing valuation. Then we're doing the little laundry list of these little smaller chapters. So just keep reading ahead. Let me know if there's anything I can do to help along the way. And I'll see you next time. Put your name in the chat for me. Have a great weekend.